there's this contrast between what the bond market thinks and what the equity market thinks.
We believe that there's a balance that's going on, and that's a good thing.
I don't think it's a recession, but the economy is clearly slowing down.
The chances that this is a slowdown are pretty strong now. What kind of slowdown? Much less certain.
Recession's not the base case.
This is Bloomberg Surveillance with Jonathan Ferrell, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get your trading day started. Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Wednesday, still just about within 1% of all-time highs on the S&P 500, following yesterday's very mild gains and going into what many people call the earnings report heard around the world. Bramo, Nvidia, coming right up.
Yeah, considering the fact that it's been the biggest gainer and the biggest input into the market gains so far this year, up some 174% year to date, up some 1,000% since October of 2022. Question is, what does a beat look like for a company that's expected to grow earnings by some 70% over the period of time?
Stock is up by 0.5% this morning. It is up by almost 160% year to date. The run has been absolutely phenomenal. I think we all have the same questions here, Lisa. When will the data center capex begin to let up? How big is this moat around this company? Can they carry on increasing overall wallet share?
Yeah, the upgrade cycle and the question of how far it can go, especially as essentially is becoming the new iPhone. It's the new Nvidia chip and how much you have to upgrade with the new and latest bells and whistles. To your point about how quickly it's adopted and how broadly, one of the more interesting aspects of the Blackwell chip, which is their update that they're going to be talking about, is how much it actually saves energy. How much do you start to see some of the broad-based gains, the broad-based market reactions based on the application of these chips, not just the massive spend by the Magnificent Four or whatever you want to say that are really fueling some of these gains?
The analysts on Wall Street have built up about this name in a big way. That won't come as a surprise. I was looking at the breakdown on the Bloomberg terminal this morning. Check this out. 66 buys, 8 holds. There is not a single sell on this name. Sometimes on this program we talk about career risk on Wall Street. This name is part of that story.
Well, yeah, we were talking about that yesterday in terms of, with Matt Stuckey, just the idea that that's been about 400, 500 basis points of outperformance by owning it, or on the other side, underperformance if you don't own it. This just raises the question of how much of a systemic risk Nvidia is. And I know, it's sort of mockable. How can you actually find risk in a name that's up this much and that's so incredible and is revolutionizing our world? Yeah. But there is this feeling that on one hand level, if they disappoint, there will be a mass crowding to the other side that will be dramatic. They won't disappoint, but that's basically, out there.
Very on brand to think about the downside risk, though, Lisa, as always. From New York City, welcome to the programme. If you are just tuning in, equity futures on the S&P 500 firmer by 0.1%. Your scores cross-asset look like this. Let's get to the bond market and check out the 10-year. The 10-year yield just about unchanged, 382.16. The euro negative. The dollar showing some strength here, 111.34. As of yesterday, at one point, we were on course, Lisa, for a 6th consecutive week of dollar weakness, set to avoid that based on this price action.
Yeah, I was actually reading a number of stories and analyst reports overnight about the question of how far dollar weakness can go. And it's a heated debate. There is actually a group of people, a cohort that just says this is a pause with a more protracted dollar weakening cycle, especially with the fiscal deficit, especially with the potential Fed rate cuts. Then you start to look at growth in other regions. You start to listen to some of the rhetoric out of the Euro region, for example. Woof, that's scary. You take a look at what's going on in China. They're about to issue bonds that could potentially burst a bubble in real estate. Woof, I don't know that I want to go there. So where are you going to go? And it's just this two-sided debate that really is coming to the fore. Right now it's not doing anything. But I think that that's something I'm going to be watching.
We said this yesterday. Everyone's got their own problems. And I wasn't just talking about sort of therapy and individuals. And
we could, though.
Lisa and me, we could. But we're talking about other countries. I was reading JP Morgan as some of their work just yesterday coming out of Asia. Normalising rates is just one piece of the story. Can we actually rebalance growth differentials, which is the piece of the puzzle that you're getting to?
And how do you do that without selling materially more debt, which is essentially what governments are trying to do to stem off some of their budget pitfalls? This is a huge conundrum, especially at a time where you have a property market that is so leveraged and so offsides with respect to supply and demand.
OK, so big day ahead. Let's start with the rundown, the next 60 minutes or so. Coming up on the programme, Steve Wieting of Citi as markets await Nvidia earnings. Akela Gardner of Bloomberg as Harris agrees to a first campaign interview, and Chris Marinac of Janney Montgomery Scott on what Fed rate cuts might mean for regional banks. We begin with our top story. All eyes on Nvidia. Stocks on pause awaiting earnings from the world's most influential stock. The $3 trillion chip maker's results expected to set the tone for risk assets worldwide when it reports after the closing bell. Steve Wieting joins us now for more. Steve joins us from Citi. Steve, great to catch up with you, sir. Let's just get straight to it and think about Nvidia coming a little bit later. Given the recent price action, given the fact that leadership has come from elsewhere more recently, particularly at the back end of last week, just how vulnerable or not are we to one earnings report after the bell later?
Well, let's keep in mind, now, it's not this way for every company in the S&P 500, but about 3% of all quarters since 2009 have been below consensus, right? So it really is going to vary very much on positioning. It's going to depend on forward-looking aspects of the report, where the whole street is on this. But the reality is we've just had a quarter with 9 out of 11 sectors have posted EPS gains. We are restoring growth in other sectors. So part of what we've been thinking about is are we just rotating out of tech, the fact that we're just off the highs, not so much on a single stock, but on the NASDAQ 100, or are we just broadening the market generally? And we think that fundamentally we are going to see more sectors, more types of companies grow earnings, and the need to rely on a single stock to power the market, I think, is diminishing.
Steve, just to build on that a little bit more, another way of asking the same question, really. Do the gains elsewhere need to be at the expense of names like Nvidia, or can the whole equity market participate? What are your thoughts on that?
Look, I don't think that there is anything in the aggregate that's going to lift us very sharply. We just had that opportunity. It came in early August when everyone believed that we were on the leading edge of a new collapse. We had a lot of de-risking in leveraged trades. That was a real opportunity. The SOX semiconductor index was down 25%. That was a market dislocation that could lead us to a really large gain. I don't think that we're going to be running away in markets, particularly at this point ahead of the American election.
Just to put a bow on that before we get to the American election and just sort of what that does to cap potential gains, I am curious, does this just basically mean that you think that Nvidia earnings are going to be less of an event than people think they are?
I think we've already lost the dependence on large cap tech as the only thing that can possibly work, right? Now, we have not had the view that every leveraged company in the world, every small cap was going to have some massive kind of rebound from depressed conditions. We weren't going into this with depressed conditions. But the reliance on a single story, a single piece of the AI puzzle, being so important that the market has to completely depend on that. I think that dependence has come down some, particularly with the correction that I just mentioned, July, early August.
So are you saying that basically the main driver right now is macro policy, is the Fed, and not necessarily the earnings picture, which has been benign enough to allow this broadening out?
Look, I think we have diminishing inflation, falling interest rates. Now, suddenly, again, we have a bond market that has some components of richness to it, and we have economic growth. And as I just mentioned, profits growing in 9 out of 11 sectors. And you know what they're growing? Over 12%. That should be good enough to power gains in the market. But if you think that this is this depressed opportunity, well, we just saw one. And the reality is we came back pretty hard from that. We should be looking for very mid-cycle kinds of gains. Everyone has some story about the next great big bust or, the huge returns that we can have in some corner of the marketplace. And the reality is we are in a fairly sweet spot that's been priced decently into the market. Of course, if we take a look at relative opportunities, we think that it's equities over bonds, particularly on a global basis.
How much are you actually seeing companies report adaptations of artificial intelligence outside of, say, the Magnificent Seven? We talk about it broadening out. And earlier in the year, there was this idea that it would stem from the adoption and sort of the cloud of joy that people were getting from the AI adoption.
Sounds like the Harris campaign.
Well,
what's going on here? The cloud of joy.
All right, come on. I'm just talking about sort of the euphoria around AI. I'm just wondering if we're actually seeing it.
Compared to the build out of AI infrastructure, putting tens of billions of dollars in capex from a handful of companies. If you wanted to find a micro level boom, it's in that spending. Yet on a very bottoms-up basis, the number of companies that are reporting that AI is material to their revenue is going up. The actual applications are getting more and more interesting. You're going to see it in our business. So I think that it is going to be the case that we're going to see, fairly profound economic effects over the next couple of years. Whether that can make any single company or sector's profits soar, I think it's going to be more diffuse in the economy, and that by itself makes it harder, to call that a couple of companies or the broad stock market is going to have something that you're going to really notice is driven as powerfully as the initial stages of AI infrastructure build out.
Nvidia only one piece of the puzzle for the next 24 hours or so. Let's take a look at the calendar together. Nvidia coming out a little bit later. Then tomorrow, the big one for the bond market, jobless claims tomorrow morning at 8:30 Eastern Time. All of that in anticipation of September 6th, which is the payrolls report for the month of August. Morgan Stanley's Mike Wilson caught up with us a little bit earlier last week. He said there is potential here for another downdraft. Here's the quote, Steve, that he shared with us. If we get another negative number, the market can react as bad as it did in July at the index level. Steve, do you think we're prime, vulnerable to just another shock like we saw at the start of August all over again?
I would argue no. And the issue is, I think since we had this period in early August, that we have essentially de-risked a bit beneath the surface. If we still take a look at large cap tech companies, if we take a look at the positioning that we have in leverage trades. Just think about yen carry trades. One measure that we use in the futures market has come off by 85%. We are not back to the races completely. I don't think that vulnerability is very high. And then we have all of the people just taking a look at historical analogies of, what happens when we're about to have an election. Let's get really apprehensive. So in essence, we're already somewhat apprehensive. So I just don't think that we're in the same position for that kind of hit. Of course, there are shocks that can occur. just take a look at the global news flow in terms of petroleum supply, anything that can happen to anyone on the campaign trail. But this is a market that I think has taken down its risk level somewhat. It's also brought it back significantly, but it is not at the level that we were in terms of vulnerability in mid-July, for example.
Steve, appreciate the input. As always, thank you, sir. Steve Wieting there of Citi, going into Nvidia earnings after the close a little bit later. After that, catching up with the CEO, Jensen Huang, a conversation you do not want to miss. Ed Ludlow and the chief of one of the most influential stocks on the planet sitting down for an exclusive conversation. Lisa, that is truly must-watch TV.
Especially at a time where there's so many questions about whether they can continue with the incredible adoption and incredible growth in spend, especially because you've seen investors push back against some of these big tech companies about how much they're spending, and the companies shoot back at them. You know what? You would be unhappy if we didn't do this.
You've touched on the issue for me as well. If we go back to what we heard from Alphabet, and I keep going back to this quote, where he was basically telling analysts, the CEO, Sundar Pichai, was basically telling analysts that the bigger risk here is underinvesting and not overinvesting. And that's going to be the first place I look to. Downstream AI use cases around the Nvidia story, their biggest customers. Are the investors of their biggest customers losing patience with this story? Are we starting to see just some small cracks? Will they get bigger as the year progresses?
And what we've heard from companies themselves, not a chance. Whether we see that actually in NVIDIA's response will be interesting, especially as people raise this question of if you have some sort of delay to the latest upgrades, instead of the iPhone, the Blackwell chip, the in chip, right? But there's this question of, does that mean that people are going to hold off on their investments for longer? So far, it's been no. I want to hear more about that.
Nvidia in the pre-market up by 0.4%. Equities calm this morning. Equity futures just about unchanged. Let's give you an update on stories elsewhere with your Bloomberg brief. Here's Shahara Hackers.
Hi, John. HSBC's incoming CEO is said to be considering plans to remove layers of middle management at the bank. Sources say that may include cutting the number of country heads across its global network. El-Hedari is also likely to shake up the executives and roles that will report to him after he takes the reins next month. Meanwhile, we're seeing shares of Nordstrom rallying up nearly 9% in the pre-market. The department store operator offering an optimistic view for sales this year, followed by better than expected results at its discount chain, Nordstrom Rack. It's the latest sign shoppers are pivoting to off-price options as they hunt for deals. The company's net sales and profit for the second quarter also beat Wall Street expectations. And NFL owners voted to allow private equity firms to buy as much as 10% stakes in their in their franchises, loosening some of the tightest ownership rules in professional sport. Deals are expected to happen quickly, with firms including Arctos Partners, Ares Management, and others already vetted and approved. Stakes could sell for as much as $1 billion, and teams that could see interest include the Philadelphia Eagles, Miami Dolphins, and the Buffalo Bills. That's your Bloomberg Brief. John?
Yahara, thank you. Steve Pagliuca coming up a little bit later. Of Bain, you know him of the Boston Celtics and Atalanta football. If you're interested in Italian football, we're interested in Italian football.
Obviously.
Of course. Steve's coming up a little bit later. The opportunities for PE here, Lisa. I just think, look at the NFL and how unique it is in this country when it comes to sports content. I think of all the TV programs last year, the top 100 in this country, 90% were NFL games. That's how expensive, how valuable that content is.
It's fascinating from every point of view because it's valuable for the PE companies, but you have to imagine when they try to extract value from some of these football companies, the contracts start to look very different with some of the media outlets as well. And that is what I'm curious about as well.
We'll get into that a little bit later. Up next on the program, Harris taking questions.
Since we've had Vice President Harris ascend to the top of the ticket, almost everything has been scripted. And those unscripted moments are really where voters are going to have an opportunity to get a sense as to whether or not they're going to vote for her in November.
That conversation up next. Live from New York City this morning. Good morning. Live from New York City, it's a calm, quiet start to Wednesday morning. Equity futures positive by 0.05%. Things get busier as this session grows older. We've got Nvidia earnings after the closing bell. In the bond market, yields just about unchanged. The 10-year 381.97. Under surveillance this morning, Harris taking questions.
Since we've had Vice President Harris ascend to the top of the ticket, there hasn't been a sit-down interview for her. There hasn't been a debate. Almost everything has been scripted, and those unscripted moments are really where voters are going to have an opportunity to get a sense as to whether or not they're going to vote for her in November. The Trump team sees a lot of momentum in the Harris campaign and want to see if they can disrupt that with those unscripted moments.
So here's the latest. Kamala Harris and her running mate, Tim Walz, sitting down for their first interview with CNN tomorrow. The interview coming as Harris faces criticism from Donald Trump and other Republicans for failing to take reporters' questions and avoiding substantive discussions on policy issues. Joining us now, someone who follows the Vice President very closely, Bloomberg's Akela Gardner. Akela, wonderful to catch up with you. Let's just start with the format. What's the reaction to the format in the last 12 hours?
Yeah, so we found out this is going to be an interview with Vice President Harris and her running mate, Tim Walz. They're going to be sitting down with CNN. I think most people consider Dana Bash a very serious and tough questioner, so that is something that people were certainly watching for, particularly because President Biden and Harris have really chosen to sort of focus their time in media with influencers, people who are already friendly towards the campaign. So that is the first reaction there. But also the fact that it's a double sit down here. You're meeting with both Harris and her running mate, so that potentially takes some pressure off of Harris. But really the anticipation up until this moment has been because Harris has not really faced serious policy questions about her platform and some of the flip-flops she has done since she ran for president in 2020, really before Biden chose her as his running mate. So she's going to have the opportunity to do that and really explain some of those flip-flops, particularly because Donald Trump has really hit her, as along with J.D. Vance, on her lack of specificity, on her flip-flops, and now she's going to have a chance to really explain that face-to-face here with Dana Bash and CNN.
Kayla, what's the word in terms of why she chose to make this a double sit down? You said it takes the pressure off her, but doesn't it potentially open up a liability that she's meeting with her, also with her vice presidential running mate? This question of, is she basically not taking charge, or is she somebody who isn't really in the driving seat?
Well, I think for one, they're still very much being introduced to the public. Both Harris and Tim Walz here. I've covered Harris for a long time, and particularly when there was concerns about Biden's age, I had voters know who she was, but they didn't know very much about her. And so I think that is part of the concern here, is that they are both reintroducing themselves to the public. Many for Tim Walz, people didn't really even know him in D.C. He was never really a big name. So they're both sort of trying to established both of their records here. And I think for Walz, his agenda as well as governor has been under attack by Republicans for being too progressive. So I think both of them have a lot of questions to answer in this regard about why they're now moderating and taking on an agenda that looks a lot more similar to President Biden's.
I recommend that people read David Leadhart's column in the New York Times, 21 Questions for Harris at a time, where there are a lot of questions by media, in particular about the flip-flops that you talk about. I'm thinking in particular about immigration, taking a much harder line, or, for example, 4 years ago when she said it is actually wrong and backward to think that more police officers will create safety. A key question now as she tries to double down on this idea of creating law and order. Has she given any indication on the campaign trail as you've been traveling about trying to reconcile some of the gaps in her policy perspectives?
I think she really hasn't. She's really largely running on a record that looks very similar to Biden's. But one thing that analysts really point out is in 2020, the party was moving so to the left. She was in support of banning fracking, something that's not really popular in those blue wall states like Pennsylvania. She was in support of Medicare for all, really a public health care system option, something that she's no longer in favor of. And she's now also pushing for that Senate bipartisan agreement on immigration that we saw almost get to the finish line, but Donald Trump really intervened, making sure that did not pass in the House. And now the party is in a different place. The party is very much moderating. Things like immigration have become a real vulnerability for Democrats. So it is, one, a recognition of the politics of the country and what it takes to win. She is Democrats' only chance right now. She is not in a primary. She is trying to win a general election vote. So that means undecided voters, independent voters, and potentially some Republican voters as well.
Okay, now let's try and drill down on taxes and what we do and don't know. Let's start with what we do know. What do we know about her position on taxes?
We know that she's in favor of not raising taxes on anyone making less than $400,000 a year. Not a huge surprise there for a Democrat. That's the same promise that President Biden made. But she's also in favor of raising taxes on the wealthy, on big corporations. But really beyond that, we haven't really had a lot of specifics. A big question here is also tariffs. Trump, of course, is arguing that he would like to raise tariffs specifically on China. But as we've seen with President Biden's administration, he left most of those tariffs in place, even though he maybe necessarily didn't oppose or agree with them. And I wouldn't be surprised if Harris takes a similar, almost neutral stance on tariffs as well.
Questions, of course, about regulation too. Are we going to keep Lina Khan or not?
It's a great question. I think a lot of people in the tech industry are sort of hopeful about Harris. She is someone who has been sort of pro-immigration, or not immigration, excuse me, innovation. And she's really worked a lot on artificial intelligence. And so there are some indications that she could potentially be more pro-business or business-friendly than Biden was. I did reporting that she's met with some of the biggest names on Wall Street. CEOs have come to both her residence and the White House. So she's certainly been picking the brains of CEOs and Wall Street, trying to get their assessment of really how the Biden administration and their state of regulation has impacted them. So she's certainly going to be someone who has a listening ear, but again, still a Democrat here.
Akela Gardner of Bloomberg. Akela, thank you for dropping by and catching up with us on some of the strategic ambiguity around the Harris campaign.
Well, yeah, and here's the issue. Can she have an interview where ostensibly she'll be asked some of these difficult questions where she doesn't give answers or gives answers that are not a potential liability to her campaign? And this, I think, is what you're hearing from Donald Trump's campaign. Reconcile these things. And, oh, yeah, when you're not scripted, that's when things really are more visible to people. It's the reason why this is an important interview.
Look, if you were critical of the fact that she's hardly taken any questions from any leading broadcasters here in the United States of America, I think you might take some comfort, like this much comfort, that there's finally a sit-down conversation. You'll be highly disappointed with the format. Highly disappointed. It won't cut it. It really won't cut it.
This is why my question is this the beginning of others, or is this it?
I hope so.
Yeah, I mean, I think that a lot of people do. Did you read about why she chose Dana Bash?
No.
It was really interesting.
What's the story behind that?
It was MSNBC was considered too left.
Of course.
Fox News is considered too right.
Okay.
ABC already did the debate. You have, or is going to be doing the debate. You had...
what is CNN? Because people would like to know.
CNN hasn't done one of the debates, but is considered friendly, but not as friendly as MSNBC.
You think CNN's happy with that?
This is just what I was reading. And Dana Bash did the previous debate and was considered, a hard interviewer.
Let's see what we get. From New York City this morning, good morning. This is Bloomberg. from New York City. Welcome to the program. Your scores in the equity market shaping up as follows this Wednesday morning. Equity futures just about positive by 0.05%, adding to the very mild gains of yesterday on the S&P 500. It's a really, really quiet start, but things are going to pick up. Nvidia, which is up by about 10% this month alone, 10% on a $3 trillion name is not nothing, is it? It's up another third of 1%. This is the stock to watch, Lisa, a little bit later on.
If you look at how much it added to the overall S&P 500 since ChatGPT came out, it's pretty astronomical. Question here about whether it can continue that momentum, what a beat looks like. Is a meet expectations a massive miss? Probably, considering the fact that they've always managed to beat and raise quite considerably. Then the second question is, how much of a runway do they actually have at a time where they can't keep these kind of growth rates up? And we haven't yet seen the adoption that a lot of people were talking about. Adoption. Same thing. It's Wednesday. Big day.
Same thing.
Oh, yeah.
Mandeep Singh of Bloomberg Intelligence. He can speak. He's going to join us in just a moment.
That's an upgrade from
Lowering
some
the
people
bar
on
from
set.
the two of us this morning. It's a long week already. Let's turn to the bond market. Treasury yield shaping up as follows. Mandeep, so much better than that. Yields are lower by 4 basis points. The 2-year, 385.88. Very tight trading range over the last couple of weeks. We're at the lower end of that trading range, on a closing basis at least, on a 2-year yield. Lisa, the 2-year auction went okay.
It was strong. People came in. You saw it actually with bids outweighing some of the offers in a more significant way. Key question today, we've got $70 billion of 5-year notes being auctioned off, and tomorrow we've got $44 billion of 7-year notes. Do you see the same kind of enthusiasm for more duration? And I think that's going to be more of a question. We said that yesterday wasn't going to be dramatic. It wasn't. It led a little bit of a rally in the 2-year, but not so much the long end. That's the reason why that's interesting.
Things get more interesting when you go from 2 to 5s and then on to 7s, and that's what we'll do over the next 24 hours or so. Jobless claims tomorrow morning. That's when the story starts to change for this bond market as well. We're looking for 232 on claims, 232,000 tomorrow morning at 8:30 Eastern Time, bang in line with the previous week. And that is when a meet is a beat. Get 232. A lot of people will be very happy with where jobless claims are at.
They're not increasing. Even though we're at a bit of a higher rate, it doesn't really highlight this kind of massive decline. HSBC's team, led by Max Kettner, put out a really interesting report. A lot of different analysts are scouring corporate earnings calls and trying to understand the language, what they're saying. They said they're not materially hearing about more layoffs in those earnings calls. Across the board, in the U.S. and in Europe, raises a question, where are these layoffs going to come from that are going to tick up? And that's one of the things when people challenge some of the gloom and doom and kind of shifting priorities of the Fed, just how much weakness is there really out there?
What's the theme of this program been over the last week? Contradictory evidence. OK, Andrew Honhorst of Citi will find some contradictory evidence to everything you just said. Looking at the consumer confidence numbers and the labour market weakness is starting to emerge. He said this: there's a growing share of respondents that are saying that jobs are not plentiful and that jobs are hard to get. In our view, the labour market will weaken further this year, which would weigh on consumers. Just more contradictory evidence there.
Yeah, and you want to take the flip side. Consumer confidence and the headline number came in at the fastest pace going back 6 months. So, I mean, you put those two things together and there you go.
Let's get to the FX market. Somewhat easier. The dollar's stronger today. Euro dollar down to about 111.29, down by 0.5% on that currency pair. Dollar yen up to about 144.40, up by 1/3 1%. So that's a weaker Japanese yen and a stronger US dollar. The dollar, as things stand, DXY, up on the week by 0.25%. And if we closed here today, it would be the first week of dollar strength going all the way back to July 19th. We've had 5 weeks of it. 5 weeks of it.
The Fed came out and perhaps was a bit more dovish than people expected, and it sort of reset expectations for Fed rate cuts. But there's a limit, and the limit is capped by what we see over in Europe, considering the fact that you're not seeing growth there, and there are questions about how much they're going to cut, considering the weakness that they have in the backdrop. So it raises this real question. To me, this is one of the most interesting aspects, given the overweight in the dollar. How much can we actually unwind that?
More on that a little bit later. Euro dollar down to about 111.30. Under surveillance this morning, Kamala Harris sitting down for her first interview. The Vice President and her running mate, Tim Walz, speaking with CNN tomorrow night. There was some disappointment with the format, let's put it that way, by the same people who were disappointed by the fact she hadn't sat down for an interview. Look, people will always be disappointed. Is the point valid or not? I would suggest, I think it's a valid criticism. We're all sitting there hoping for a one-on-one conversation and you get 2 for 1. In this case, 2 for 1 is not what people were looking for.
The fact that she's sitting down with Walz, 2 questions. Does she still answer substantively, right? Do we get something more than talking points? Does it become basically a filler kind of interview where there's a lot of noise from both of them and not so many questions? Or is this going to be something where she can actually hang her hat on some real policy positions? Is she going to come out and say, we're going to replace Lena Khan, we're going to change our immigration strategy, and this is why I've changed. This is what we're going to do with taxes and price gouging. This is how it's going to lower prices, considering all of the pushback. We're probably not going to get that, but a lot of people are hoping for that.
Shape-shifting's unreal, right? I've changed from my positions in the 2019-2020 primary. OK, it's a primary. We understand you've got to go to the left a little bit more to try and win it. Struggled to even win it. Didn't even get into the primary, really. Dropped out before the voting started in 2020. So those positions aren't her positions anymore, right? That's what's implied. But some of the positions from the administration are hers, but some of the positions from the administration aren't hers. Is that what we're meant to take away from the last 3.5 years?
I would say my question is shape-shifting beneficial for her? Can she actually come out and say, I am a shapeshifter because I reflect the wills of the people, and this is how I shapeshift, and this is sort of my criteria, what goes into that strategy? Is it sort of more of a scenario analysis, not to go to Fed speak, but a scenario analysis rather than simply trying to state her claims so that people can anticipate what her rule would look like? And I think that's the big difficulty. People don't have a sense of that right now, and that is what they're looking for.
We hope this is the beginning of an ongoing conversation about policy. The fact that people are still complaining about the format, this is still an issue. Still an issue and not going away anytime soon. I want to turn to the latest reports from Bloomberg, here at Bloomberg, on Apple, the iPhone maker, cutting about 100 jobs in its digital services group as part of a shift in priorities for the division. The layoffs include some engineering roles, as well as in the Apple Books and Apple News teams. Now, job cuts at Apple are pretty rare, and I think this really does underline where the emphasis is starting to shift, not just at Apple, but at other companies too in tech.
Well, it's interesting that this is coming right after the exit of a longtime CFO that oversaw the shift to services over product. I just wonder if it's as much of a routine kind of stepping aside and shifting back and enjoying his money at a 60-year-old age, because why not? Or if this is actually a shift in strategy for Apple, which has seen sort of lackluster gains in their services relative to expectations. I mean, they have been gaining revenue, but a lot of people were expecting services to lead the charge, and some of the media outlets to really take off, be real competitors to the likes of Amazon and others. It's unclear whether that's actually coming to the fore.
Got it made, hasn't he? Tens of millions of dollars and an Italian passport.
Okay.
Does it get better than that?
All right. Okay. Really, you had to throw that in. You do that every time you talk about the importance of going to Italy to vacation, buy a villa. I will talk about bond auctions. How about that?
I assume he's got an Italian passport anyway. I assume he's still got one. Let's turn to Nvidia. Traders counting down to Nvidia earnings after the closing bell. The results expected to set the tone for risk assets and serve as a barometer for AI spending across the tech industry. Analysts betting on another blowout report predicting that the company will project revenue growth of more than 70% for the current quarter. Mandeep Singh, one of the very best, joins us from Bloomberg Intelligence. Mandeep, good morning.
Morning.
Can we start with expectations? And Lisa said it. Can we keep beating and raising at this company? Can we do it again this afternoon?
They will. And historically, what we have seen is when companies have, such high growth rates at the base where Nvidia is at, there is always a pull forward component to what they are doing. And there is rationalization in the market. Now, whether that rationalization will happen this quarter or 2 quarters from now, I think the latter is more likely simply because the market is undersupplied. But these kind of growth rates are unsustainable. And right now, what Nvidia valuation reflects is continuation of this 30 to 40% CAGR. And that's what worries me, because you just cannot sustain these valuations at the growth rates that they currently are.
When you say they're unsustainable, are you suggesting that the data center capex is about to let up? It's about to pull back in the next 12 months or so?
I mean, every company right now that we talk to is looking for ways to utilize their existing GPUs better. And also, what can they do in the software layer to reduce their reliance on NVIDIA's chips? Basically, you are training your model. There's the only game in town is NVIDIA when it comes to building a large cluster to train your models. But then you want to do things at the software layer that make it easy for you to reduce your reliance. And you didn't have that option 6 months back because there was this race to get the GPUs. But now that companies are training, they're trying to figure out ways to reduce their reliance. And that's where I feel the market always rationalizes. Yes, there was a supply shortage. They have sniffed that. And every company is trying to figure out ways how to overcome that shortage. And that is what will affect NVIDIA. I mean, look, the Blackwell delays is one thing. It's got to do with, their product roadmap and how well they execute. And they probably will execute better than other chip makers. But the question comes down to what are the industry participants going to go and how are they going to deal with this supply shortage? And my expectation is they will be innovative at the algorithm layer, at the software layer, to reduce their reliance on NVIDIA going forward.
I love having you on, Mandeep. It's always such a breath of fresh air. It's always this contrarian take, sort of trying to throw a little bit of cold water onto the raging, roaring fire that is the enthusiasm for NVIDIA. But when we talk to other analysts, including someone coming up, Angelo Zino, he's going to basically tell us they have a competitive advantage. There's no one who's really coming up against them in a significant way. At the end of the day, isn't that the reason why they can continue this growth? There's no one else in town.
You're right. So AMD, Intel, they're far behind. Broadcom is an alternative. So every hyperscaler that is developing their own chip is looking at ways to leverage Broadcom and the other chip makers to do this in-house. But they're far behind in terms of executing the way NVIDIA has. And for large language model players like Microsoft, Meta, Google, they want to focus on the model itself, on the applications. Why focus on chips right now when there is so much opportunity at the model level? Still, they're going to be innovative at the software layer because traditionally what we have seen is that's where all the, the moats accrue. The software companies have a much higher gross margin. And I think that's how this cycle will play out. I mean, I'm super bullish on generative AI and, this whole cycle. It's just a question of whether people will continue to rely on NVIDIA to develop their next model. And the scaling laws do apply in this case because the next model will be bigger and better. Question is, will it be all driven at the chip level or would there be software and algorithmic improvements? And my bet is the latter.
Ed Ludlow's going to be interviewing Jensen Huang later on. What do you want him to ask him?
The hyperscaler risk, really, because right now, $60 billion in incremental revenue that we are going to see from NVIDIA this year at the data center level, more than half of that is coming from the hyperscalers. Now, will that continue? What are his expectations in terms of that hyperscaler CapEx continuing? And there is a big bet on sovereigns. So really, I want to understand the customer base that NVIDIA has and how sustainable that growth is across their customer base.
Mandeep, this was awesome. As always, Mandeep Singh there of Bloomberg Intelligence. The earnings day moves on NVIDIA over the last 2 quarters had a 9% move last time, had a 16% move the quarter before that. Unreal.
Especially when you consider what that means in terms of market cap. We're talking some $300 billion swings on any given day, and it's always been swing up. So you just wonder how much that's a market driver versus a market crusher when it comes to this idea there can be a broadening out when you still have the behemoths driving the train.
Stock is up by 0.4% early in the session in the pre-market. Let's get you an update on stories elsewhere with your Bloomberg Brief. Here's Yahara Hackers.
Hi, John. The 2 richest people in China saw more than $16 billion wiped out after record-breaking stock sell-offs. The founder of beverage company Nongfu Spring lost some $3 billion as shares fell by a record 10% yesterday in Hong Kong. Meanwhile, PDD Holdings founder Collin Wang's wealth tumbled by over $14 billion as those shares fell the most in company history after it warned revenue growth would inevitably slow down. Remember, PDD is the owner of the popular shopping app Temu. Overall, the move signaled deepening investor concerns over Asia's biggest economy. Meanwhile, Bitcoin posting its biggest drop since the broader market sell-off in August, trading as low as about $58,300 earlier, though as you can see, it's now retracing some of those losses. Other major tokens like Ether also unwinding the lift they received last week from Fed Chair Jay Powell's clearest indication yet that a rate cut is coming. Traders are now looking ahead to results from Nvidia after the close today, with the bellwether AI and chip company expected to shape investor appetite for risk. And Britain's Dan Evans won the longest match at the U.S. Open since tiebreakers were introduced in 1970. Evans' upset win over 23rd seed Karen Khachanov, taking 5 hours and 35 minutes. Evans also fighting back from 4-love down in the 5th set to win the marathon match. Elsewhere, 3rd seed Carlos Alcaraz comfortably moved into the 2nd round, as did women's top seed Iga Swiatek. That's your Bloomberg Brief. John?
Yahara, thank you. I've got to share this. Lisa won't mind. Lisa comes in the studio. right before the start of the program. He says, I've pulled a muscle in my arm. I said, what have you done? I was playing catch. Playing catch. These guys, 5 hours with that intensity.
But they stretch, and they have lots of training. I don't have a trainer to go play catch.
That feeling when you start to get older, your body just can't do what it used to do.
Okay, all right, that's exactly what I was thinking about.
I feel the same thing.
I was thinking, were they okay? Did they have to be taken off the court?
What was my response? I said I pulled my back the other night, standing up waiting for a car for an hour, just standing there. My back went. Up next on the program, dealing with the trash.
We saw a big short squeeze last week in some of the smaller banks in particular. And, that's driven by, technical dynamics. I think there's still a lot of trash.
That conversation up next, live from New York. You're watching Bloomberg TV. Stocks are positive, just about up by 0.05% on the S&P 500. Bond yields going nowhere, 381.40. The dollar stronger, which really goes against the grain of the last few weeks, the last month in fact. The euro negative by 0.5%, 111.26 on euro dollar. Under surveillance this morning, dealing with the trash.
We saw a big short squeeze last week in some of the smaller banks in particular. And, that's driven by technical dynamics, but also the prospect of increased demand for things like mortgages and loans and perhaps some improvement in the balance sheet assets that they have. I think there's still a lot of trash. I don't think inflation is gone, and you still have to be wary of that.
So here's the latest. Let's focus on the financials. The KBW Regional Banking Index hitting a 2-day slide following last week's 5% rally. Chris Marinac of Janney Montgomery Scott remaining constructive. Banks are expected to retain earnings and boost capital ratios since loan growth is very modest this quarter. Companies are being careful to extend new credit, and most are wary of new CRE loans. Chris is with us for more. Chris, welcome back to the programme. Banks, as you have noted, have had quite a run. 20% move in some places since that presidential debate at the end of June. The move we've had more recently, how would you describe that? And how would you distinguish between solid names that are going to improve in months to come, quarters to come, and maybe the trashier names you want to avoid?
Well, I think there's been some profit taking day to day, John. I think that's normal. For the most part, we're going to be in a trading range until we get into earnings in October. I think the conference season in September should be generally positive. Most banks aren't seeing any new credit quality problems, but credit really is the issue. And I think when you talk about banks being labeled trash, I think that has to do with the perception that credit is going to deteriorate in the quarters ahead. And to some extent, that's dependent on the economy. We still think banks are going to benefit from lower interest rates. And, the official Fed policy cuts, if they start next month, can be very beneficial to the cost of funds for banks, for net interest margins widening. And it's really going to give relief for the real estate loans that have to be worked out. So to some extent, lower rates are going to help the sector. But certainly, we still have an economic cycle to contend with.
Chris, when you have a look and sort of dissect the rally of the last couple of months, you noted the end of June and that presidential debate. How much of this has been about a relief rally on lower interest rates, and how much of it has been about political considerations?
I think it's much more about the Fed and very little about the politics. I think we have a lot to uncover as it pertains to the election, to the regulatory environment. We still have the Basel III rules that will take place in some shape or fashion. We are going to see tighter capital standards and tighter liquidity for the industry. That's not going to go away. It just might be watered down from the original proposals last year. So we still have more wood to chop, as the saying goes, as time passes. I think the Fed rally in rates has really helped. I think we are going to see valuation marks at the end of September, which help. But I do think we still have to work through the credit perceptions in the quarters ahead.
Chris, John mentioned that 5% rally, which we saw on Friday after the Fed's speech, after the Fed said the time has come to start lowering late rates. I am wondering, we saw the biggest rally, that 5% rally going back to the end of last year. Does that really mean that rate cuts will be positive for these regional banks, even if it comes with slower growth?
Well, sure. I think the biggest issue of the past year, particularly when Silicon Valley and the others failed last March, had to do with the cost of funds surging and really that whole catch up of deposit costs. So that's now come and gone, and we're starting to see wholesale borrowing costs roll over the past 2 months. If the Fed cuts rates and SOFR and Fed funds indexes come down, a lot of your exception-based pricing that customers have received on deposits can begin to adjust. Many banks are waiting for the Fed policy move to begin to lower their deposit costs. So it's going to benefit things in the fourth quarter, first quarter of next year. We also have this concern about the valuation of bank securities, and that keeps getting better every quarter. And these marks are going to be 3.5% to the positive, which is a very big move quarter to quarter at the 9:30 mark.
Will these rate cuts, Chris, prevent some of the consolidation that a lot of people think is necessary?
No, I actually think it'll accentuate the consolidation. We've seen an uptick in deals the last 3 weeks. We had another, 2 mid-sized banks merge in the Midwest. I think more of that is coming. The Key Corp news of a couple of weeks ago with Capital really portends additional regional bank considerations. The Fed, I think, is open to consolidation. I think the capital rules are going to spur that when they become adopted at the end of this year or early next. So I actually think lower interest rates will change the perception. And we'll get through the election and we'll have our knowledge on where regulatory reform goes or does not go. But I still think that lower rates are going to ultimately be beneficial. It just changes the perception for the space. And as I mentioned, I think that real estate workouts, which need to occur, will be benefited from 25, 50 basis points lower rates.
Chris, just to put a bow on it, how different is this moment? Traditionally, we talk about lower rates, and then we go on to say a slower economy. That doesn't sound too good for the financials, for the banks. What is it about this moment? Why is this moment so different? We're talking about lower rates and a slower economy, but banks are going to do well?
So banks had pressure on funding heading into 2023. And then when Silicon Valley failed, everything changed and the perception of liquidity changed dramatically. So now that we have banks growing very slowly, the capital retention is going to be greater. We also have the valuation marks improving. But more importantly, you have less pressure on funding. So I think the banks can actually be very successful with zero balance sheet growth, retaining earnings, and having a little more flexibility as it pertains to working through the credit issues that are still out there, particularly in commercial real estate.
So, Chris, what are your top bets right now, given the fact that it will lift all boats, but some are going to be lifted a lot more than others?
Sure. First Citizens, FCNCA, Fifth Third. We like Synovus at this valuation level, still like Wintrust, WTFC. And I think that even though New York Community was the bane of everyone's worries back in March, the company has come a long way and the stock is still very cheap on a book basis.
Hold up, Chris Marinac. Let's pick up on that name. What is it about that name that you like? And what's the feedback from clients when you suggest it?
Well, I think on New York Community, the losses in the mortgage book and the multifamily book, that is, are much less than perceived. Many of these owners have tax issues if they don't pay. They're not going to default. They've been in their families for generations. They are going to repay. Some of those loans will move and get refinanced from Freddie Mac. I think that ultimately the company's book value is going to bottom around the 1550 range, and the price to book should improve. It's going to take a few more quarters for them to get back to profitability. But the company's credit worries and a lot of their fears about deposit runs just simply were not true. So I think there's a comeback happening on NYCB, which is why the stock's interesting at this level.
Hey, Chris, thank you. Chris Marinac there of Janney Montgomery Scott. The final comment regarding NYCB. NYCB was a name we didn't mention too many times this year, but when we did, it wasn't good.
Well, it came with the idea of some policy shifts, specific policies in New York City that led to a devaluation, particularly of loans to rental properties because of some of the rent rules, and as well as other properties, residential in New York City. Question here about whether this is a policy view or just looking at the base observations. If you don't get defaults, this looks like valuable stock. It just questions, what is trash, John? Why don't you talk about that?
Did you see some of those moves over the last year, since the lows of last year?
Oh, yeah.
Just had it up on the screen. Some of the moves over the last 12 months on these regional names, absolutely phenomenal. Huge moves.
Part of it is because they're coming off such a low base. I mean, they got beaten up so badly and had such low valuations. Question of just how sustainable some of these moves are, given there still is so much skepticism. I mean, there's some people who call them trash.
Who would do that?
No, I mean, it's just not fair.
Who would do such a thing? I'm not talking about all of them. I'm just saying that some of them have just traded higher off the back of the relief rally surrounding the lower rate story. That's it. That's all.
And that's trash.
It's not a buy everything moment.
Well, that's
but it has been. It has
right.
been.
That's actually exactly the question.
Should it be?
Yeah.
That's the question.
And is New York Community Bank everything?
Yeah, okay. Coming up, trying to get me in trouble, David Rogal of BlackRock. John Lieber of Eurasia, Boston Celtics co-owner Steve Pagliuca, Daan Struyven of Goldman Sachs. All of that and more.
Be careful what you wish for if you're hoping for an aggressive cutting cycle on the part of the Fed.
We need restrictive policy. It just doesn't need to be as restrictive.
Burns on the inflation data right now.
There's room for inflation to surprise on the upside.
I don't think inflation is gone, and there's stuff to be wary of that.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now. Let's start with the scores with the equity market unchanged this morning on the S&P 500. Equity futures going absolutely nowhere after yesterday's mild gains. On the Nasdaq, up 0.1% on a Russell of small caps. Almost down 0.1% on a Russell 2000s. The day ahead and the week ahead. Things get a whole lot more interesting in the next 24 hours. Coming up later, after the close, earnings from Nvidia. Then tomorrow morning, 8:30 Eastern Time, jobless claims in the United States. They are the two big hits of the week. Nvidia earnings later, jobless claims tomorrow morning.
Let's put these ideas together. Nobody's doing anything this morning. They're watching and saying, when do I have to pay attention after the bell at 4 p.m.? That is actually really compelling to me. How many people are still at the office? How many people are preparing to actively trade? If you have thin trading and you have a $300 billion move in Nvidia, what does that do to the rest of the market? This is what we were exploring yesterday, and we have to continue to exploring today at a time where this market is very dependent on one specific name.
Have we put to bed the concerns of early August? August 2nd, the jobs report drops. It's a couple of days after what we heard on the ISM manufacturing. Jobless claims were a little bit higher that Thursday going into payrolls. Then there was this big scare, growth scare, off the back of higher unemployment and a jobs number of 114. Have we put to bed those concerns?
They haven't put to bed anything. I mean, let's be honest. Yesterday we were talking about consumer confidence. And on one hand, you had it come to the highest level, come out at the highest levels going back to the beginning of the year. Great. Yay. There's no weakness. What are you talking about? Oh, wait, you look at the jobs expectations. It actually came in significantly weaker. If you take a look at people's confidence that they could get another job, though that rate was dropping to the lows that we saw in 2021. You put that together and you've got the same clarity that you did 2 months ago.
It's a problem politically as well for the incumbent and whether you consider the vice president the incumbent. I think by definition, the incumbent, she's the vice president. She's going to face some questions in the next 24 hours from CNN. A first sit-down interview. The format, though, people have been critical. The fact that we haven't had many sit-down interviews. In fact, we have had none, zero. And they're still critical because of the format, because the vice president will be sitting with her VP pick for that conversation.
There are always going to be criticisms, obviously, from the other side. That is part of the whole game. This one, as we've both mentioned, is pretty valid. It is important to understand how she thinks so that you can really extrapolate out how she will rule, how she will govern, given the fact that she has shifted her policies. I keep going back to less of the criticism and more what we need to hear. More some of the policies that people, particularly in the business community, are looking for. One of them is, will Lina Khan stay on? You mentioned this earlier. Another one of them is, can you explain to us your tax policies? Another, price gouging. Exactly how will that lower prices considering some of the pushback you've heard from the business community? It goes on, not to mention tariffs, not to mention immigration. Key questions, which is the reason why people still throw out that this is a huge risk heading into November, considering we just don't know the answers to these questions.
We are moments away from a conversation on the fiscal trajectory on this country and what it means for fixed income and the sovereign debt market. Don't miss that. Equity futures right now unchanged on the S&P 500. If you are just joining us, welcome to the programme. In the bond market, yields lower by a basis point, 380.84 in the FX market. The dollar showing some strength against pretty much everything in G10, including the euro. The euro down 0.5%. Euro dollar 111.25. Coming up on this programme, David Rogal of BlackRock on the Fed's policy path, John Lieber of Eurasia Group with US-China talks underway, and Daan Struyven of Goldman Sachs on why he cut his oil outlook. We begin with our top story. Stocks facing the next big test today with Nvidia earnings due after the closing bell. Investors also looking ahead to fresh round of jobless claims numbers tomorrow for clues on the Fed's path ahead. David Rogal of BlackRock weighing the impact of rate cuts, writing the following. As the Fed recalibrates policy, we see curves steepen out. 2's-10's curve, 2-year forward, is 60 basis points steeper than current levels. That's a pretty normal curve shape in a soft landing type of environment. David joins us now for more. David, we'll get to the curve in just a moment. I want to take a giant step back and talk about valuations and where we are. How attractive is the current setup in fixed income for you and the team?
Yeah, I mean, we think it's an incredible time in fixed income. If you look at valuations, you can get almost a 2% real yield in fixed income. You look at the TIPS market, you go back a couple of years, for a decade, we averaged negative 1% real return in cash. That was the era of financial repression. It's a completely different environment today. Bonds are also providing more hedging value in portfolios as inflation comes down. So you'll see the counter-cyclical monetary policy. You should get more hedging value. It's not inconceivable in a severe growth downturn that you could get a high single-digit return in a bond portfolio. And as the Fed starts to recalibrate policy, we think you will see curves normalize. That's going to drive more money out of cash into intermediate fixed income. We've seen more investors looking at our total return product. We think you should be looking at active, diversified, and flexible strategies in fixed income. If you look at bond indices today, they're becoming very concentrated. We have over 40% of the ag and treasuries. And as fiscal deficits continue, you're going to see those treasury weights increase. If you look at something like our total return strategy, we recently launched an active ETF, BRTR, off of this strategy. We hold 20% in treasuries. We hold 30% of our portfolio in non-ag assets. So we think investors should go into a more diversified, multi-sector approach in fixed income.
Can we get to your thoughts on cash? I want to dig deeper on that.
Sure.
We need to see the curve normalize before we unlock the cash. So people that come on this program and talk about the $6 trillion of cash that's sitting in money market funds, you're saying one thing needs to happen before we see the other.
I think you're starting to see investors get ahead of it. So we've seen pretty strong inflows into bond funds this year. And I think, there's a lot of money. There's not just $6 trillion in money market funds. Household net worth is now up to $160 trillion, relatively low bond allocations. So we think there's a lot of dry powder that could come into the market.
I guess if you take this a step further, there's a question of how much of this cash can go into duration, right? This issue of how much value are yields actually providing and how much further can they go? At the core of what John is getting at, there's a question of how much of that $6 trillion wants to lock in 10-year yields of sub 4% at a time where you have some real questions about whether those yields are actually going to go lower. Isn't that the case?
Yeah, I think the intermediate part of the curve looks pretty attractive to us. I'd say on the Fed, if we look at what the very front end is saying, if you look at what the Fed's saying, we see this cycle as being more of a recalibration. If you look at the front end, we're pricing 100 basis points of cuts at the next 3 meetings, and we're pricing terminal rates below 3 now. So I think there's a lot of uncertainty on what the front end's going to do. There's a lot of uncertainty on where terminal's going to be. But I think when you look at the intermediate sector, the valuations are okay. We do see it as more of a recalibration cycle. The market in the front end does seem to be a little bit ahead of itself from a valuation perspective.
You're not talking about the long end. Why?
On the long end, it's not a place where we're allocating significantly our portfolios. I think we want to be a little bit more cautious. When you look at the fiscal trajectory, I think it's worthwhile to take a step back and look at how it's evolved. For many years, we had counter-cyclical fiscal policy. So when unemployment rose, you tended to see the deficit expand. And then in 2016, we evolved into more of a pro-cyclical fiscal policy as you saw tax cuts. And that was continued in 2021 with Biden's stimulus. You saw more tax cuts in a relatively healthy economy. I think where we are today, you're seeing more structural deficit spending. If you look at the CBO forecasts, they're forecasting 6% of GDP deficits for the next 10 years and a 20-point rise in the debt to GDP ratio. And you look at government spending, most of it's non-discretionary. And so the scope to reduce that or improve the deficit outlook is going to involve some pain. And so we think over time you're going to see more term premium as a result out the curve. The fiscal trajectory is going to be with us for a while. We think right now you're seeing a lot of demand for fixed income from the household. If that takes a pause, you could see more volatility in the market.
Can I build on that just a little bit? Yeah. And maybe I'm taking this too far. The Treasury market has always allowed the Treasury to act counter-cyclically because people go into bonds when things go bad and yields are lower. Now, I'm just sort of guessing here, and you can correct me if I'm wrong, if this is an unfair characterization of your stance or not. Are you suggesting that when we go into the next economic downturn and the deficit has to expand even more, that Treasury yields might actually rise and not fall?
I wouldn't necessarily go that far. I think you could see a steeper curve than perhaps normally you would if we're in a severe growth downturn. But yeah, no, I wouldn't necessarily go that far.
So you think bonds still act as a ballast in the portfolio for bad times?
I think for the most part, yeah. I think you're seeing that more today, more than you have been in the last 2 years for sure.
Well, I guess that just to sort of put some numbers on it, have you quantified that extra risk premium associated with the structurally higher fiscal deficit?
Yeah, it's a very hard thing to do, and I think by most measures today, term premium is fairly low. I think what we've seen is that term premium has come down across most measures, and really a lot of it is determined by where you think the neutral policy rate is going to evolve to, and I think there's a fair amount of uncertainty on that. Right now, if you think the neutral rate is closer to 4%, there's not a lot of term premium in the bond market. If you think the neutral rate is closer to 3%, kind of closer to where the Fed's long-run estimate was, then valuations look more reasonable.
How much do you care about bond auctions?
I think the bond auctions are going pretty well. I think you look at the 2-year note auction. Yesterday it was a good day for the Treasury.
It's just waiting for a failed auction, David.
Yeah,
When's it happening?
No.
And on what maturity?
I'm just wondering whether other people I'm waiting for other people to be waiting for a failed bond auction.
Okay.
I mean, are other people watching this as closely as I am? Do people care when I care, or is this just me in a vacuum? That's my question.
No, I mean, I think people are very focused on it, but when you look at the metrics for most of the bond auctions, they look pretty healthy. The bid-to-cover ratios, everything looks pretty good.
Nothing to see here. David, thank you. Appreciate it.
Thanks
David
for having
Rogal
me.
there of BlackRock. Lots of thoughts there, particularly about this curve normalization that we need to see to really encourage that cash to start coming out of money market funds.
And the curve normalization is really talking about 1 to 7 years, not really talking beyond
True.
that, because this is the sort of question mark that a lot of people have. And, I have to say, the reason why that was an interesting conversation is it is not the first time that we've heard that. We've heard that from so many people. The long end, I don't know, yields are going to be affected more by the fiscal trajectory. And then Bob Michael comes out, what are you talking about? Money going to bonds. Money goes into bonds, and
There's
it goes
a
into
higher
all
structural
bonds.
deficit. It's undeniable.
Yeah.
And it's happened in good times.
Correct.
Or at least relatively good times compared to where we have been previously. Let's give an update on stories elsewhere. Here's your Bloomberg Brief with Yahara Hackers.
Hi, John. U.S. Special Counsel Jack Smith has filed an updated indictment against Donald Trump on charges of trying to overturn the 2020 election. The new indictment cuts out claims related to Trump's communications with government officials after a blockbuster immunity ruling from the Supreme Court. But it still includes the same 4 charges accusing Trump of conspiring to reverse the election's outcome. The parties are set to file a report with the case's judge later this week with proposals on next steps. Meanwhile, Warren Buffett continues to unload shares of Bank of America with his Berkshire Hathaway selling an additional $982 million. Berkshire has trimmed its stake by a total of almost 13% in a series of sales since mid-July, generating $5.4 billion. Yet Berkshire still remains the bank's biggest stockholder with almost 904 million shares worth nearly $36 billion. And another big podcast deal, NFL brothers Travis and Jason Kelce have signed a 3-year, $100 million deal with Amazon for their popular New Heights podcast. The deal allows Amazon to sell ads on the show's video and audio feeds and distribute it globally, and includes the show's back catalog. The podcast launched in 2022 and saw a massive boom in listeners after Travis began dating Taylor Swift the following year. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in 30 minutes. Does she get a cut or not? Isn't that what you want to know?
I just want to know, what is the association with the Taylor Swift effect? Would it be 10 million versus 100 million?
Huge.
What if she's my sister?
We can have a more cynical conversation in a moment in a commercial break. Up next on the program, steadying global ties.
President Biden has been very clear in his conversations with President Xi that he is committed to managing this important relationship. We are working to ensure that competition does not build into conflict.
That conversation just around the corner, and a brand new note from Dan Ives over at Wedbush. The day is here. Godfather of AI on deck. Get the popcorn out. More on that note in just a moment. From New York, this is Bloomberg. Dan Ives of Wedbush. So here's the note. The day is here. Godfather of AI on deck. Get the popcorn out. Get the popcorn out. Ed Ludlow sitting down with Jensen Wang a little bit later on. After the closing bell after we get the numbers, so look out for that later on Bloomberg TV. Here's the fuller quote from Dan Ives. In a nutshell, we expect another drop the mic performance from Nvidia, as right now Jensen & Co. are the only game in town with $1 trillion of AI capex on the way for the next few years, with Nvidia's GPUs the new oil and gold. What do you make of that from last line?
Well, he's been talking about this, how this is sort of revolutionizing the economy in ways that go beyond even what the railroad did. I just want to know, he's going to be joining us tomorrow at 6 a.m. How bright is his outfit? How many different patterns? Sort of, is there some sort of scale that the better the performance, the brighter and the bigger and the more mismatched
fluorescent it becomes?
The more fluorescent and multifaceted. Maybe there'll be tassels.
Likes the clash. Yeah. Put it that way. All right. Dan's coming up tomorrow morning, 6 a.m. That'll be our lead story tomorrow. After the close, the numbers drop. Equities right now totally unchanged going into this on the S&P 500. We go nowhere. Yields lower a basis point on the 10-year, 380.65. Under surveillance this morning, steadying global ties.
President Biden has been very clear in his conversations with President Xi that he is committed to managing this important relationship responsibly. And the outcomes of the Woodside Summit and the work we have done since then demonstrate that we are working to ensure the competition does not veer into conflict, and that we find ways to work together where our interests align.
So here's the latest. U.S. National Security Advisor Jake Sullivan and his Chinese counterpart kicking off a second day of talks set to discuss a range of issues, including foreign policy and trade. Bloomberg reporting that Sullivan will aim to make clear he won't speak for the next U.S. administration. John Lieber of Eurasia Group looking ahead to the next election and writing the following. Harris would maintain the status quo with regard to Taiwan and would prioritize keeping the U.S. out of regional conflicts. John joins us for more. John, in some ways, that's been the approach of this administration as well. And in many ways, it hasn't helped. If that's the approach, do you ignite more concern and perhaps not less?
I think the goal for both the Harris and the Biden administration has been to keep guardrails around what's obviously a declining competitive relationship. And nothing that Sullivan says when he's in China and nothing that Harris or her team say in the next couple of months is going to change any of that. The fact of the matter is that Washington views Beijing as a rising threat, and they're willing to take actions and steps in order to contain that threat. But what they don't want is to get involved in another war or another actual hot conflict. And that's what this visit is all about. It's about keeping channels of communication open. It's about maintaining warm relations. And despite what they're saying, I do think this is about signaling that there be continuity in a Harris administration between what the Biden team has been doing, which sets up a contrast with what Trump is trying to do, which is a much more aggressive approach to China.
So let's talk about tariffs. That's what it ultimately comes down to, John. Tariffs. Tariffs in the early part of the Trump administration were about a lack of reciprocity. You're putting tariffs on us, we'll put tariffs on you. In fact, we'll go further unless you do X. Then it became about national security, much more so under this administration. We don't want to sell you this because we don't want you doing that. When it comes to leverage, John, and this is what I'm struggling with, the lack of clear evidence that we're able to find any real lever to gain leverage over the Chinese to influence their foreign policy. What can the West do to influence the Chinese to change their view about how foreign policy should be conducted?
I think the big thing you're getting at here is Taiwan, and the Chinese absolutely have been resolute that Taiwan is actually a part of China, and that someday will be reunited with mainland China. And that's the single biggest flashpoint and the single biggest red line for the Chinese that the Americans they do not want the Americans to cross. And I think that's kind of hanging out in the background of this entire discussion. One thing you didn't mention when you're talking about tariffs is jobs in the U.S., because that's really what I think the tariff regime is about. It's about decoupling from China, particularly in a second Trump administration, trying to bring jobs back to the U.S. And right now, that's a bipartisan thing, with the Biden administration making massive investments in terms of subsidizing green energy in order to bring a construction boom back to the U.S., to create jobs. So that threat of Taiwan is out there. The Chinese have been very clear the U.S. cannot cross that red line. And the Americans are now saying, our goal here is actually to protect ourselves, but also to bring jobs back to the U.S.
John, you talked about continuity from the last administration to the new one, whichever it would be. Do we have a sense of what Kamala Harris's policies would be?
Not really. She hasn't really laid out a specific China policy, and actually she hasn't really laid out a lot of specifics on any policy. At the convention, she did make a point to talk about a strong national defense, but we don't really know what that means. I mean, the U.S. has massive fiscal challenges. That's probably going to determine the path of its national defense and the size of its military over the foreseeable future. Harris has said she wants to be strong here, but that could mean anything. And one of the questions for her, one of the big challenges she's going to face is what happens when there's a provocation. What happens when the Chinese try to stop the Philippines from resupplying the second Thomas Shoal, for example, during her administration? How strongly does she confront them? And we just don't have a sense of that from her. Some of her personnel are going to be left over or brought along from her vice presidency. Most of the Biden people will probably cycle out, but it's really difficult to infer exactly what she will do when that 3 a.m. phone call comes.
How much is that framing some of the conversations that you're having with clients, both corporate and other governments?
I think the big question about what Harris is going to do is on the mind of every single person that we talk to. I think on domestic policy, it's a lot easier to predict. I mean, she's going to inherit a Biden platform that looks like most other kind of Democratic platforms, which won't be that different because it will require Congress. But on foreign policy, presumably she continues what she's doing with what the Biden administration is doing with Ukraine. Presumably they continue this strategy of engagement with China. But what the specifics of that look like, who are the people making the decisions? These are all big questions that our clients are asking us.
John, as a journalist, we can sit here all day and complain about the lack of access. There will be a little bit of access. There will be a sit-down conversation together with her running mate. The complaints will continue regardless. But ultimately, I look at the results and whatever you think about it, the strategic ambiguity, the lack of access, the lack of clear policies, it's working based on the polls. Now, John, you and I have been talking for a while. We all have about the so-called double haters. How deep is that pool of double haters? And how well has this administration, or rather this campaign, how well have they done at tapping into that reservoir?
Yeah, they're doing a great job consolidating support among the Democratic-leaning independents who didn't like Joe Biden. And you see this in Harris's approval rating, and you see this in her poll numbers, where it looks like over the last few weeks, a lot of voters have come back home, both to the Trump campaign and to the Harris campaign, as both of their numbers of support have risen in most polls, but Harris is by a lot more. So that double hater group is probably going to be a lot less relevant in this cycle than it was in either 2016, when Trump and Clinton were the least liked candidates ever, or 2020, when Trump was so deeply unpopular. So I think the double haters are less relevant here, and Harris is doing a very good job of presenting herself as kind of the normal, reliable, predictable option relative to Donald Trump.
Making it less relevant, though, makes it a bigger issue for the Trump campaign. And, John, as you've noticed, there has been a ceiling. The former president has suffered from a ceiling of support. If that's the case, what's his strategy, and how does his strategy differ to, say, Kamala Harris's?
His strategy is to do what he's done in 2016, which is to pull out kind of an inside straight in the Electoral College and win barely enough votes to get him there. So he needs to win some combination of probably Pennsylvania and Georgia. Now North Carolina is looking a little bit more competitive. And he's going after young black voters. He's going after young Hispanic voters. He's going after the disconnected kind of voters who are supporting RFK, people who aren't regular voters. It's a high-risk strategy, but that's what he's got because he is not your typical politician.
John Lieber of Eurasia Group. John, appreciate it. Thank you, sir. The latest on the relationship between the US and China and what it means for the rest of the world, and the latest in the horse race as well, going into November.
Well, the horse race and the lack of knowns is actually really interesting, as every single person who's come on this show who just analyzes markets and invests has mentioned this as sort of the wild card hanging out there. People don't have a sense of what either candidate would look like when in practice, right? Whether it comes to foreign policy or whether it comes to economic policy, which is why we are hearing on the margin some companies are holding back from making certain moves or trying to get ahead of the election if you're borrowing money in order to avoid some potential volatility there.
More on this story a little bit later. Let's turn to the price action. Equity futures unchanged on the S&P 500. Big day coming up after the closing bell. Earnings from one of the most influential companies on the planet. Numbers from Nvidia after the close a little bit later. Up next on this program, we'll catch up with the Boston Celtics co-owner Steve Pagliuca as NFL owners vote to let PE firms invest in their teams. The latest on that just around the corner. From New York, this is Bloomberg. Stocks unchanged on the S&P 500, going absolutely nowhere. On the Nasdaq, going somewhere slightly kinder, down 0.06% on the Nasdaq 100. On the Russell, the small caps, some relative outperformance, but this is pretty muted stuff so far this Wednesday morning. I'm going to stop scraping a barrel, switch at the board and get to the bond market. 2-year, 10-year, 30-year. Had a decent 2-year auction yesterday. 5s today, 7s tomorrow. The 2-year 384.65, the 10-year 380.65. A reluctance from a guest from BlackRock just a moment ago to go too far along the curve, Lisa. Some concerns about the structural fiscal deficit in this country.
There's a feeling that at some point the music's going to end, especially because you're borrowing in good times, not just bad times. And as he was mentioning, a lot of the spending is non-discretionary, so it's going to have to keep going unless there really are some hard decisions, the likes of which are very unusual in Washington, D.C. So there's a real question here about how much that's going to affect the auctions and how much this is going to affect some of the demand. So far, unclear.
He's looking for a steeper curve. And we need that steeper curve to really encourage more money to come out of money market funds. So when we have people come on this program and the conversation starts regarding these $6 trillion of cash in money market funds and even the household wealth, to unlock some of that wealth, unlock some of that cash, you need to see curves start to normalize a little bit more.
I just am channeling Phil Camporelli. Imagine him sitting here. It's like nails on a chalkboard for me, the cash on the sidelines. Right. Just put it in equities. What are you waiting for? There are a lot of people who sound like him.
Make it happen, make it happen. Let's turn to foreign exchange. The foreign exchange story, I think, is interesting with regards to what happens in the bond market, or rather what is going to happen with Federal Reserve policy. Euro dollar at 111.26, dollar yen at 144.35. For today at least, we've got some dollar strength against the bulk of G10, if not the whole of G10. Over the last month or though, some serious dollar weakness for 5 weeks. We heard from the likes of Stephen Jen in the last 24 hours, and I think Stephen Jen's point on what might happen with the FX market is pertinent to the conversation in China, but Japan also, and maybe in other parts of the world too, about unlocking big outflows. Chinese companies may be enticed to sell $1 trillion, a $1 trillion pile of dollar-denominated assets as the US cuts rates, and that could mean a strengthening of the Chinese currency of up to 10%. They're not the only ones thinking about it.
Especially as there is prospect of growth in other regions, like Japan. China perhaps is a less clear story about whether they repatriate that money into a yuan at a time of some real structural considerations there. My big question is, how much is this because there is a belief that the Federal Reserve is going to cut rates more aggressively than, say, the ECB? Because remember earlier this year we were talking about how the ECB would definitely cut rates more than the Federal Reserve, and now it's sort of a question mark. TBD. And I think that that's what we heard when we talked to ECB officials in Jackson Hole. Basically, just watch. We'll see what we're going to do. It seems like September's a given for them, and how often they'll move is still kind of hanging out there.
The euro negative today by 0.5% at 111.27. Under surveillance this morning, investors are awaiting Nvidia earnings after the closing bell. Expectations are very high, with analysts predicting the AI giant will project revenue growth of more than 70% for the current quarter. After the numbers drop later on today at 6:30 Eastern Time, Bloomberg's Ed Lieber sitting down with the CEO, Jensen Huang. Do not miss that conversation. We've had some fireworks over the last few quarters on this name. A move of 9% last quarter on earnings day following earnings. A move of 16% the quarter before.
Fireworks is the absolute correct word because they're always shooting upward. They're not ever shooting down. That 16% gains, those are all gains. Those are not losses because of the outperformance. Mandeep Singh had a wonderful question, which is how long can they rely on some of the hyperscalers, meaning the big tech players that are financing their entire shift, right? How much is that going to continue versus broadening out in demand, and how long can they sustain that kind of spending?
I want to get to that record move. I'm trying to find the headline on the Bloomberg terminal. Bear with me as I scroll. It's the end of July, wasn't it? The record market cap move that we saw in this name.
I don't know. I'm not looking for it right now. I don't have it.
No, I'm going to get to it right now.
Okay, good.
The number is right in front of me.
Well,
I'll bring you the number right now. Give me a second, Lisa. 329 billion. 329 billion in market value added in a single day. The biggest market cap move in a single day in market history.
To me, the fact that that's sort of the biggest market move has become normalized. People are expecting another record move today. I mean, the base case of 10% is very close to that of $310 billion. This has become everyday type of reactions. The penny stock of Nvidia, that actually is the biggest stock out there, some $3.1 trillion in market value.
Seen it in the treasury market too, which has behaved like a penny stock at times as well. Anyway, That's that story. Here's this one. Meta closing an augmented reality studio as the company shifts its focus to artificial intelligence. The studio was first launched to compete with Snapchat and allows developers to make digital filters that are overlaid into videos in the company's apps. The fact we're talking about this, I think, just informs the strength in the story we were talking literally seconds ago.
Basically, the AI story has overwhelmed the whole idea of the metaverse and how all of our little agents, our little, avatars are going to go and connect with other avatars. That whole story has sort of gone out the wayside by being overwhelmed by something that seems
They've got to change the name again, haven't they?
What, to AI? To
probably
artificial.
Credit to Mark Zuckerberg, though. When he sees something, he goes all in, and he's got at least the humility to turn around and say, not going so well, pulling back, going all in elsewhere.
Is he going all in on his jewelry company? I'm just wondering. I mean, doesn't he have like a jewelry company with his chains and such?
Oh, something like that. I don't know enough about it.
But no, it's true. You're right.
You should watch The Exchange with Emily Chang.
I will.
Yeah, it's quite a change. Quite a change from Mark Zuckerberg in the last year or so. Yeah, all of that. Let's turn to this one. The NFL ushering in a new era, voting to allow private equity firms to buy stakes of up to 10% in its franchises. The move is expected to attract billions in fresh capital, boosting the valuations of teams that had already been surging to new highs. Joining us now, the co-owner of the Boston Celtics and Atalanta Football Club, a good friend of ours in this program, Steve Pagliuca. Steve, welcome back to the program, sir. I want to talk about what exists now in world sports and what, until this moment, hasn't existed for the NFL. Steve, can you walk us through the opportunity here for private equity and the difference between just the traditional view of taking a controlling stake in a company and the operating business and starting to influence the decisions that it makes? What are we about to see take place in the NFL?
Well, it's a great question, John. The people are confused a little bit in that the private equity model applied to the NFL or applied to the NBA is very different. It is more, I would call it an investment fund policy rather than private equity policy. Classic private equity firms go in and buy companies and then try to grow them and grow the revenues and earnings and globalize them. That's not the case with sports investments. Sports investments will be done by specialized funds like Arctos, Dial, already in existence today. And they take limited partnership stakes, and they're limited to 10% in this NFL deal, I think 30% in aggregate in the NBA deal. And those will be passive stakes, really made to open up the market for folks that want to invest in sports properties. And they've created an asset class. So it's a little bit of a misnomer to say it's private equity buying in. It's a passive limited partnership position so that more people can have access and have capital into the booming sports business.
By improving the liquidity for some of these companies, Steve, does that necessarily increase the valuation? How do you think about that?
It doesn't necessarily increase the valuation, but given the values, for example, the average NBA team probably 20 years ago sold for plus or minus 300 million. Now it's at 3.5 billion or so. So the amount of capital involved to buy an NBA team is large. So it would be helpful in terms of filling that capital gap, which used to be filled by wealthy individuals, but those numbers are huge at this point.
Steve, what do you think about unlocking value in some of these names in terms of where these companies are, where these sports teams can be seen? And I'm wondering, as some of the cable news versus streaming channel kind of arrangements are negotiated, do you think that a greater degree of PE involvement or just outside investment involvement is going to expedite that shift just simply to the higher bidder, not necessarily to some of the classic cable channels?
Well, I think the leagues really do a great job. Adam Silver and Udo have had great experience with the media, and the NBA contract was up like 2.6 times from the last time. The NFL contract also up dramatically. What really is the upside is sports have become globalized now. When we purchased the Celtics in 2002, there was no streaming, there was no capability for kind of massive live global distribution, and that's changed with streaming. And now we used to count fans in the tens of thousands. You can count fans in the hundreds of millions and even billions for many of the big soccer clubs, the global sports like basketball and football. So I think what we're seeing is a long-term trend of globalization of sports, and it's one of the few programs that aggregates eyeballs, and that's very valuable to the new media players and the old media players. And that's why you're seeing such increases in the rights.
I like that you went global. I know that you go global, and you have gone global, in particular in Italy. And I know that John is very jealous and talks about it all the time. And I think that we all really want your life. I do think, Steve, there's this question of whether you like international sports, European soccer still, as really the mainstay. I see John kind of sighing with this frustration, as I call it, soccer rather than football. But I'm just wondering whether you want to stay with that kind of theme or whether you want to head back and invest more in the U.S. after the Celtics investment as well as others.
Well, I think everything is situational. Investing is all about the price you pay and the trajectory you think the business can go on. And so at Atalanta, we thought that was a fantastic franchise. We have a great partner in the Bacassi family. And so far that's worked out. There's a lot of luck involved, but we were very lucky to win the European Championship. So it's really situational. You need to look at clubs. We look at clubs all over the world in football, other sports. And it's all about where you see the trajectory going and what the price you have to pay to get there is.
Well, Steve, let's talk about the trajectory, and we can compare and contrast global sports with what's happened in the NFL. I was looking at the Nielsen ratings, ranking the 100 most watched programs in 2023. 93% of them NFL games, which, Steve, is absolutely phenomenal. They've just dominated the highest rating TV shows in this country now for the last couple of years. Can you say the same thing about global sports? When we talk about European football, Steve, have we hit a plateau when it comes to the valuation of TV rights? Do you see any way of unlocking more value?
You know, I think for John, we talked 5 years ago and 10 years ago, we thought we'd reach plateaus, but we haven't reached plateaus. And again, the reach is growing because of streaming and multiple channel capabilities. And they've gotten more sophisticated about how to divide the packages up. So I don't think we've seen a plateau because it's so valuable to aggregate these audiences. And the NFL has done a fantastic job. They have a league that has parity. They have games that are important every week. The NBA has done a fantastic job with growing viewership and growing access to the game. And so I don't think we've seen the end of that yet because the global, the worldwide internet companies, the Facebooks, the Amazons, and the old media, they need this programming and they need those eyeballs. And as you pointed out, that's incredible. In the USA, 93 out of 100 programs were sports related, were NFL related.
Can you say the same thing about European football?
I think European football is continuing. They continue to change the format of the Champions League, UEFA, Serie A, make the broadcast schedules better. So I think right now we're in a little bit of a lull in media rights in European football, basically because the streaming wars just ended or didn't end, or it really ended 6 months ago, a year ago, when people realized that there's too many streaming channels, too many options, and so everybody's cut back on programming. So we've had these cycles. There's a kind of a momentary lull when there's bundling and unbundling, and right now things are less robust. But I think it will come back when there's mergers and acquisitions, and you come back to 4 or 5 global players who were competing for these sports properties.
Well, let's finish on acquisitions and your interest. Your name was associated with Chelsea Football Club a few years back, Steve. I just wonder whether you still have that interest in acquiring another club in European football.
Yeah, we were looking at different clubs in European football, and we think it's continued to grow. It's a great opportunity. There's lots of things that you can do to improve the product and expand the reach, as I said. And so, yeah, we think it's a really interesting area.
Steve, could you share with us cities, places, countries, just a better idea of the clubs you have looked at?
Yeah, I think they're right now media rights are down in France, and so there's some interesting clubs in France that need capital and to grow and come back, and the French market will come back. There are some interesting opportunities to play in, as you've seen, in the UK to move teams from the one division to another. So I think France, UK, and even some things in Spain.
Are you in any active conversations right now, Steve? I imagine if you are, you can't reveal the details of them, but are you in any right now?
Yeah, we're talking to several clubs right now, and I don't know if anything come to fruition, but we can't talk about who those are. But there's several clubs that we're talking to as we speak.
Watch this space. Steve, it's good to see you, as always. When that news comes, looking forward to catching up with you. Steve Pagliuca there, the Boston Celtics co-owner, on some of the shifting rules stateside with the NFL and the opportunities elsewhere.
I just want to see a day in his life. I want to see.
That's amazing, isn't it?
How many games does he go to? Is it every night? You know, whether he cheers for them all. Would he ever buy two teams in the same sport? And what would that be if they ever went against each other?
Football, apparently.
Well, exactly. How does that work? I mean, do you basically root for both of them? Do you just avoid? Do you not have a favorite child? Lots of questions.
Amazing. Just amazing life. Love, Steve. Let's give an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Donald Trump is adding a pair of former Democrats to his presidential transition team. Robert F. Kennedy Jr. and Tulsi Gabbard are the two latest members of the Trump team after they both endorsed his presidential campaign. The move aims to widen Trump's electoral appeal in a close race with Vice President Kamala Harris. Kennedy suspended his own campaign last week and said that Trump had offered him a position in a future administration. Meanwhile, Apple is cutting about 100 jobs. Bloomberg News has learned the iPhone maker cut jobs in its digital services group as part of a shift in priorities in the division. The layoffs included some engineering roles, but the biggest cuts were made to the team responsible for the Apple Books app and Apple Bookstore. Layoffs are relatively rare at Apple, though the company has made at least 4 rounds of reductions in 2024. And SpaceX is delaying the first ever private spacewalk for the second day in a row, this time because of weather. SpaceX said it was standing down from liftoff opportunities today and tomorrow because of unfavorable weather forecasts in the spacecraft's splashdown areas off the coast of Florida. If it gets off the ground, Polaris Dawn is scheduled to be a 15 to 20-minute spacewalk by 4 private astronauts. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the programme, Wall Street souring on crude.
This is not the kind of market where it's produce or die. We've got much larger corporations running the show here, and I think they're going to find it much more difficult to discipline non-OPEC production.
That conversation up next. You're watching Bloomberg Surveillance. Live from New York City, equity futures on the S&P 500 unchanged through most of this morning, unchanged right now on the S&P. In the bond market, yields lower by more than a basis point. The 10-year 380.65. Crude right now down 1.8%. WTI 74.15. Under surveillance this morning, Wall Street souring on crude.
This is not the kind of market where it's produce or die. That's not the case here. We've got increased well productivity. We've got much larger corporations running the show here. And I think they're going to find it much more difficult to discipline non-OPEC production if they're really talking about the Permian than they think.
So here's the latest. Oil slipping once again ahead of key U.S. inventories data. This coming as both Goldman and Morgan Stanley cut their 25 crude outlook. Daan Struyven of Goldman Sachs revising his forecast to 77 a barrel, writing this: "We still assume that OPEC will raise production in Q4 as the market is potentially shifting from an equilibrium where OPEC supports spot balances and reduces volatility to a more long-run equilibrium focused on strategically disciplining non-OPEC supply." Dan joins us now for more. Good morning, sir.
Morning.
I want to start with that last line. We talked about it yesterday as well. When you say disciplining non-OPEC supply, are you talking just about shale or everything else? Who are you talking about?
Mostly U.S. shale, because U.S. shale is the short cycle, the short-term producer that responds within a year or so to price changes. Supply elsewhere in the world is mostly long cycle, where you're also price elastic, but it takes typically many years. Taking a step back, I think over the last 2 years, OPEC has really been quite effective at balancing the market by adjusting supply and to keep prices in a fairly narrow range by historical crude standards. If OPEC goes ahead with raising production, and it's very much a close call, we may learn more in coming days, we may potentially shift to a new equilibrium with somewhat more volatility, where the new floor under oil prices becomes the break-even price of U.S. shale producers.
Let's go back to the experience of the last decade, the middle of the last decade. There was a real effort from the Saudis to discipline and almost punish shale producers. Arguably, shale producers came out of that more disciplined and much stronger. What's different about this time compared to then?
So I think, as you point out, U.S. producers have very strong balance sheets now. The reinvestment ratio is significantly lower. About 50% of free cash flows are reinvested in new projects. And so I think that means that to engineer a given slowdown in U.S. shale growth, you arguably need a bigger drop in prices, because those big U.S. public producers, their production plans, they're fairly sticky, and they're very strong balance sheets. And so to us, that means that a very sharp drop in prices is not that likely. It's more likely going to be a gradual shift lower.
Some people would argue that just structurally what you see right now is you haven't seen that increased production by OPEC Plus, and what you've seen is actually inventories getting taken down at 8 out of this past 9 weeks, this according to some industry data. I'm just wondering at what point you see this as kind of feeding on itself, especially with lower rates that might sustain the recovery. How much of a counterpoint do you really take to this?
Absolutely. So we only have a modest and gentle decline in oil prices next year, from Brent sort of in the high 70s now to $74 per barrel by the end of next year, despite a moderate but meaningful surplus we have in our balance next year. Why is that? Only slightly lower prices despite this surplus, we assume. The main reason is that we do think that oil currently is slightly undervalued, meaning that prices are a touch low relative to the level of inventories. And also, if you do get these Fed cuts, you should get some upward pressure on valuations and prices, because basically the opportunity cost of holding oil is lower when interest rates come down.
So I apologize in advance for this, but your predecessor, Jeff Curry, who now is at Carlyle, came out yesterday and he said there's going to be a huge spike in crude prices because of lower rates and because of this sort of super cycle that you see on the heels of the investment in some of the infrastructure plays that we've seen globally. Why do you so vastly disagree with that?
First of all, I would like to thank Jeff for everything we and our team learned from him. It's very much building on the shoulders of a giant. And I agree with Jeff that positioning is very low, is very light at the moment. And I also agree that oil prices currently look somewhat low relative to fair value. And that's precisely the reason why, despite a meaningful 600 KBD surplus in 2025, we have a base case of only slightly declining oil prices.
77 is the average for 2025, correct?
Correct.
How much of that is about Chinese demand softening and maybe not bouncing back?
I think that the big surprise this year on the demand side has been softness in China demand growth. Actually, demand outside of China is surprising to the upside, in the US, in Europe, in India. But I think the slowdown in China demand growth, which is, I think, mostly structural, is an important factor for oil markets in coming years. To put this in context, in the 5 years before COVID, China was growing its demand of oil by almost 600 KBD every year. In the first half of this year, annual oil demand growth from China was only 200 KBD. So basically only 1/3. Some of it is a macro story. GDP is structurally growing at a slower pace. But some of the factors are oil specific and more micro. Fuel switching into EVs. Fuel switching out of diesel into liquefied natural gas, which is now cheaper as well. And we think that some of those fuel switching factors are more structural.
Are we seeing that in other commodities as well? We're starting to see that in, say, iron ore versus copper, too, in China.
So I think that the sort of 2000s China-driven commodity supercycle was a supercycle where very rapid growth in China GDP, and especially the property sector, sort of lifted demand and prices for all commodities. I think we're going to enter an era with greater divergences in terms of the demand trends across commodities, with, I think, a pretty solid long-run demand outlook for copper. It's the green metal of the future. Gold, because I think Chinese, including central bank, are looking for new assets in a more uncertain world. But then on the other end of the spectrum, iron ore, ferrous metals, where I think the demand outlook looks bleak because of a structural grind down in demand in the property sector.
This was an absolute clinic, and we've got to do it again soon. Thank you, sir. It's good to see you. Daan Struyven there of Goldman Sachs on the commodity market. Lisa, starting on crude and finishing on everything else.
I thought that was a fascinating conversation. You really do have to come back. I mean, I'm still thinking about how much the transition to other forms of energy are curtailing the potential gains in oil. And that's something that's fascinating to me at a time when we still don't understand how much that's affected the drawdown in stockpiles in the U.S., even as driving miles has increased dramatically. So these are some of the questions that I think he really highlighted there.
Average price forecast on Brent, $77 a barrel for 2025, just a little lower from where we are right now. Brent crude 78.43. Coming up, Emily Roland of John Hancock, Angelo Zino of CFRA, Stephen Stanley of Santander, and Collin Martin of Charles Schwab from New York City. You're watching Bloomberg TV.
There's this contrast between what the bond market thinks and what the equity market thinks.
We believe that there's a balance that's going on, and that's a good thing.
I don't think it's a recession, but the economy is clearly slowing down.
The chances that this is a slowdown are pretty strong now. What kind of slowdown? Much less certain.
Recession's not the base case.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
It's another quiet morning. It won't be a quiet afternoon. Let's put it that way. From New York City this morning, good morning, good morning. 90 minutes away from the opening bell. The week begins on a Wednesday. Waiting for Nvidia numbers. The scores look like this on the S&P 500. We're down by 0.1%. We're down 0.2 on the Nasdaq, down 3 on the Russell. Your day ahead, the next 24 hours or so, the numbers drop from Nvidia after the closing bell. We'll have a conversation with the CEO, Jensen Huang, an exclusive sit-down. Ed Ludlow and Jensen, as Dan Ives of Wedbush would say, the godfather of AI. 6:30 Eastern Time. Don't miss that. Then tomorrow morning, jobless claims, Lisa, at 8:30 tomorrow morning.
Yeah, we all have our popcorn out. You know that summer's almost over, right, John? I just wanted to let you know that.
So I'm told.
Yeah, but this to me is actually important, especially as you say, another quiet morning. The week starts August. At least it starts this week, because the idea of everyone on vacation is going to be very interesting. I keep coming back to this. I'm pairing Peter Scheer with the idea of what we're going to see with Dan Ives' popcorn that he's going to be eating after the bell today. How much more volatility are we going to get? How significant could these moves be on the heels of pretty low liquidity, complete lack of conviction? You've got signals on all sides when it comes to the macroeconomic picture, and one name that accounts for such a significant part of the overall index, some 6% of the S&P 500 at a time where $300 billion market cap moves have become the norm.
I'm an end of September kind of guy for the end of summer. In fact, I like to push it into October, particularly living here in New York.
Okay.
Because it's warm enough.
No, that's just unacceptable.
Just follow the temperature.
No, I'm sorry. First of all, you say all the time when we come in on January 2nd, no one can say Happy New Year. But then you can say Happy Summer until October 1st. Complete anachronism.
Okay, this is why I do the New Year thing. If you've waited 2 weeks to say Happy New Year to someone, they're not that important in your life, right? Because you've waited 2 weeks and you haven't spoken to them for that long.
So the analogy is...
So why bother?
Okay, so then
That's very different.
How long can you ask
That's
people...
just manners.
How long can you ask until you can stop asking people what they did for summer?
I don't. Is that an American thing?
What, you don't ask people, like, have you gone anywhere? What vacations did you go on? That's not your, repertoire of small talk?
That's like the first question you ask. No, more impulsive and organic when it comes to conversations. Do you plan conversations with people? Is there like a to-do list? Is that the second question after what do you do?
No, I don't ask people what they do first.
First question.
That is gauche.
What do you do?
No, that is what people say.
Hey, that's like the number one question in the United States of America.
That's Washington, D.C. The number one question in New York is where do you live?
Where do you live? And then you can figure out what you do.
And then you figure out what they do. That's sort of the...
quite British, that is.
Yeah, is it?
So you listen to accents and then you can figure out everything else.
I don't do either of those questions.
So what do you do? And then what have you been up to this summer?
Yeah.
And that gets you through conversations. It's good to know.
No, it's not that regimented.
I like to think I can sort of ad-lib and just have a chat.
But then, look, most people, they want to know where they went this summer. It sort of gives you a sense of who they are.
To compare and contrast.
This is not a competition.
How did you fly?
It's about... kindness.
Did you fly
this is not about a status symbol. Yes, it is.
Everything is about status. Give me a break.
Oh my goodness, that is not how I roll.
The number one question is, what do you do? What else is it about if it's not about status?
I don't ask people what they do.
Okay.
Do you ask people what they do?
No, it's not a me thing.
No, it's not
but
a me
it's a
thing.
thing.
It is a thing.
It's a thing. Please acknowledge that.
But do you like it when people ask you that?
We're 3 minutes into this hour. We could do the whole show. Do I like asking people what they do? No, I'm not really interested.
Cool.
At all.
That's something else. Okay, let's look at these markets.
Might be. Check them out. Have I revealed too much? Maybe.
I don't know. Right in.
Equities on the S&P, negative 0.1%. Snoozy going into Nvidia earnings a little bit later on. In the bond market, yields lower by not even a basis point, almost a basis point, 381.22 on a 10-year. Coming up this hour, Emily Roland of John Hancock as markets await Nvidia earnings, Angelo Zino of CFRA on the AI giant's competitive edge, and Stanley of Santander on why the next jobs report will be more important than core CPI. We begin with our top story, all eyes on Nvidia. Markets trading at a tight range ahead of what's being called a make-or-break moment when the chipmaker reports after the closing bell. Emily Roland of John Hancock calling it, quote, the earnings report heard around the world. It is historic that a company of this size has been able to grow at such a degree. Emily joins us now for more. So, Emily, the obvious question off the back of that quote, can they continue growing at this rate for the next year and maybe more?
Yeah, I mean, this is like an asset allocator's dilemma when one stock represents an entire asset class. In fact, Nvidia is bigger than 5 of the sectors in the S&P 500. So if they do miss, I think the big question is there a further rotation out of tech? And if those assets go elsewhere, that could be huge for other parts of the market. What we've seen is that momentum, which is basically Nvidia and Broadcom, hasn't seen quite as much love coming off the August lows as other areas of the market like low volatility. So I think this is extremely significant. I was going to make a joke like, oh, there's earnings after the close today. But I think this has been more important than even some of the key economic data we've gotten. Powell's speech at Jackson Hole last week, certainly all eyes are on this report.
Emily, there were moments in July, if we go back to July, just before that jobs report that seemed to shake up this market in a big way for a couple of days. There were moments in July where the gains elsewhere, the improved participation, were really at the expense of some big tech players. Is that the way you see things going forward from here?
Well, I think it's been just such an unusual environment for cross-asset returns right now. You're seeing this, area where, long-dated bonds, gold, and then you've got European equities and small-cap value stocks. In the secret lives of asset allocators, we think about these connections all the time, and they sort of don't make sense. So on one hand, the market's pricing in this soft landing scenario, which, by the way, has been helped a ton by a weaker dollar on the idea that the Fed's going to be cutting aggressively. That's actually helped cyclical assets outperform. This quarter, those risk-on asset classes have actually been the winner. But then at the same time, you have other market participants pricing in this, bad news scenario with areas like gold and long-dated treasuries outperforming. So we're in this very strange period right now where the music's still kind of playing, but everyone's not quite sure when the record might stop.
You sound a little frustrated, and I was reading this note and I could feel it. You could be right on the macro call that growth and inflation are decelerating, but get the asset allocation wrong as small cap value is the best performer. This idea that you could be right and still the market can move against you. This frustration with how do you focus on what the Fed is saying and the contradictory data points. Do you just take a look at what companies are saying? In other words, is that the reason why Nvidia earnings might be much more important to you than some of the contradictory data we're getting out of the U.S. Labor Department?
Yeah, I mean, I think that the macro picture certainly is important, but it's about as clear as mud right now, as we can see from that cross-asset performance. The data, the disinflation narrative is intact. Investors love that. The music is playing as long as inflation is coming down. We still have initial jobless claims. Yeah, they perked up a little bit last week, but they're still at low levels. The consumer's doing just fine. The business survey data that we've gotten through PMI has actually picked up a little bit after softening in July. So that combination of the disinflation narrative and better than expected growth is something that's really helping markets continue to run here. I think the challenge is, when does that growth actually become, bad news? Why, the Fed's probably cutting because something's wrong. So this is an environment where you have to look at the fundamentals. We want to find areas of the market that can maintain margins, that can show better earnings results in this sort of never-ending late cycle environment. And that's one reason that, we can knock on tech all day long. The earnings are there. And that's a key reason we've continued to embrace tech companies, but also diversify that with areas like quality at a reasonable price and even sprinkling in some more defensive equities.
You said at a reasonable price, and I think that's the big concern that people have right now with big tech. Is it still a reasonable price after the incredible rally that you've seen, some 1,000% gain for Nvidia itself since late 2022? I'm wondering from your perspective, Emily, how you see rate cuts affecting valuations of big tech companies. At one point that was thought to bolster them. Then it didn't matter whether rates were low. When rates rose, it didn't matter because they were are still minting money. Now, do rates matter to big tech at a time when they're actually investing their cash piles in bonds, and on the margins, higher yields are actually benefiting them?
Yeah, they don't matter as much to tech. I think it's pretty well insulated. These companies have so much cash. They have great balance sheets, great return on equity. We looked at different regimes, whether it was different regimes for inflation or rates or even political regimes. The technology sector in the United States comes out on top every time. Again, because of the earnings growth, we're bumping up on 30 times forward earnings for the S&P 500 tech sector. Yes, that certainly feels frothy, nowhere near the 50 times forward earnings that we saw during the peak in 2000. But again, the earnings are delivering. Just looking back at this last earnings season, of course, we still have this one name to add to the calculation. But, we've seen so far tech earnings about twice that of the broad market. So I don't think valuations being frothy are necessarily a catalyst. They can stay that way for some time. I think you need to see some major shift in earnings dynamics or earnings leadership to see tech take a big step back here.
This conversation really goes against the grain of the other conversations we've had over the last few weeks. And Emily, I know you follow the programme, so you're well aware of that. It won't be news to you. The participation we've seen elsewhere, small caps, all-time highs on the equal weight on the S&P 500, encouraged by this faith that a lot of people have now in Chairman Powell on this Federal Reserve, that they can extend the cycle. The chairman wants to extend the cycle, and they don't want to fight it. What are they getting wrong?
Yeah, I don't get it. You're looking at small caps rallying on this idea that the Fed's going to cut and the cost of capital is going to come down. But we have to remember the Fed's probably going to cut because something's wrong. Either growth is slowing, the unemployment rate's going to tick up, and that doesn't fare well for more cyclical areas of the market. So there are frustrations coming during this time where we're seeing these cyclical assets outperforming, this risk on participation because the Fed is cutting, and importantly, because of the weaker dollar. If you look at the outperformance of European equities, it's all currency so far this quarter. So the idea is that the Fed's going to cut so aggressively here. But again, they're probably cutting because growth is slowing. That shouldn't benefit cyclical parts of the market. Right now it is. But we would fade that trade and, again, look for higher quality assets and look to, again, you guys know we love bonds, look to the income potential that's inherent in high quality bonds to ride out this late cycle environment.
Emily, just to put a bow on it, are you saying that the downturn is going to be more significant for us to get the cuts that are currently priced in, or that the Fed is not going to cut very much and will ride it out? I mean, which is it that you see as the most likely outcome?
So the second scenario, which is, of course, the soft landing scenario that markets are priced on right now, that would be great. It's possible that that would happen, but you're betting against the odds, right? It's only happened one time, and the Fed was well ahead of it back in the mid-1990s. The Fed's usually cutting because something more nefarious is happening. It doesn't need to be scary. It could just be as simple as profit margin shrinking and companies needing to lay off workers. So we do think that that's the scenario that happens. It's hard to see right now. I think until you see initial jobless claims picking up meaningfully, until you see high yield bond spreads widen, the music is still playing. In fact, it's starting to get a little bit louder right now in a good way for investors. But when it stops, it usually stops pretty quickly. And at that point, it may be too late to lean into the income that's now available in high quality bonds.
Jobless claims at this time tomorrow morning. Emily, before you go, what did you do this summer?
I have so much conviction in the conversation you guys just had. John, I'm with you. Summer does not end until the end of September. Back to school, not listening. Summer's still happening.
Love it. Emily, thank you. Emily Roland of John Hancock, my kind of person, Bremo.
Okay, great. I think a lot of people would like to have sort of the easy summer if A, you don't work, and B, you don't have kids that no longer have summer programs that are hanging around trying to figure out what to do. There are some pressures out there that might push other people to, embrace the pumpkin lattes.
Futures down 0.1% with an update on stories elsewhere. With your Bloomberg Brief, here's your Hara Hackers.
Hi, John. Hyundai announcing plans to double its lineup of hybrid cars as demand for pure electric vehicles slows. The move will bring the number of hybrids in Hyundai's lineup to 14 as it moves beyond compact and mid-size cars to add large and luxury vehicles. However, the company kept its EV sales target unchanged at 2 million a year by 2030. Hyundai also announcing a $3 billion share buyback as part of a plan to boost investor returns. Meanwhile, Warren Buffett continues to unload shares of Bank of America, with his Berkshire Hathaway selling an additional $982 million. Berkshire has trimmed its stake by a total of almost 13% in a series of sales since mid-July. Yet Berkshire still remains the bank's biggest stockholder, with almost 904 million shares worth nearly $36 billion. And U.S. mortgage rates fell again last week to the lowest level since April 2023. According to the Mortgage Bankers Association, the contract rate on a 30-year fixed mortgage eased for a fourth week to 6.44%. The drop led to a small rise in home purchase applications last week. That's your Bloomberg Brief. John?
Yahara, thank you. I think we're all hoping that unlocks some real supply in this market. And hopefully people leave some rentals and start buying some houses, and then things get a bit more competitive with landlords as well, and tenants saying, yeah, go fish.
Hopefully for who?
Hopefully for people who might be renewing in the next 6 months or so.
What'd you do this summer, John?
Whoever that might be. Up next on the programme, the Morning Calls, plus Angelo Zino of CFRA previewing Nvidia earnings. That's next. This is Bloomberg. Payrolls, the estimate for next Friday at the moment is 155. Only a handful of estimates in so far. I can tell you Citi just published theirs. And remember, Citi is looking for a 50 basis point cut on September 18th from the Federal Reserve. These are the numbers they're looking for. They project 125,000 new jobs, and the unemployment rates remain at 4.3%. So, Lisa, the bar, I have to say, pretty low for Citi to get that 50 basis point cut in September. They're looking for 125 next Friday.
They just want to sort of see that there is sort of a deceleration. Other people saying not so much, that the bar is pretty high, including a couple guests we have coming up. Look, does it matter? Ultimately, and I keep going back to this, I'm sort of surprised that more people haven't picked up on this. Loretta Mester was talking about this, others as well. Why not start with 25 basis points and then go 50 basis points to just sort of indicate to markets we're beginning, we're not freaking out, we're not very concerned about the economy. That might be the tack they take.
I think it's an easier way to frame this, and we've heard several guests do this over the last number of weeks, in fact the last few months. If the rate for July 2023 was the right rate for that economy, how do you explain that's the right rate for this economy, given how much has changed in 12 months? And when you start to think about it that way and consider how offside the Fed might be, some people say they're not. Other people say it's anywhere between 100 and 200 basis points. So what's 25 in the grand scheme of things?
But then you could make the argument, what's 50 in the scheme of things?
Sure, you can,
And
yeah.
that's, I think, what we hear from the likes of Andrew Hollenhorst. Other people would just say 25 basis points won't move the needle, but it will indicate that they're cutting, and then they can go further without pushing the market even further.
We'll pick up on that debate in about 10 minutes. Some select guests are going to build on that. Collin Martin, Stephen Stanley, look out for that in a moment. Equity futures negative 0.1% on the S&P. The opening bell 1 hour and 10 minutes away. In the bond market unchanged on a 10-year at 382.16. Let's get you some morning calls. First up, Jefferies maintaining a hold rating on Nordstrom on the back of second quarter earnings results. The analyst saying the retailer's anniversary sale was less of a tailwind than originally expected. Your second call from Citi, raising its price target on Clorox to 165. The analyst opening a 90-day positive catalyst watch on the shares and expects a favourable earnings setup. That stock up by a third. And finally, HSBC upgrading Moderna to hold. The analyst highlighting the, quote, great potential of Moderna's new cancer vaccine as it progresses through clinical trials. That stock is up by 0.5%. Let's turn to tech. Angelo Zino of CFRA still bullish on Nvidia ahead of this afternoon's earnings results. He's looking ahead to the company's launch of its advanced Blackwell chips, thanks to the promise of greater market share. Angelo joins us now for more. Angelo, welcome back to the programme. A question I think we've got to lead with is a question that you've been addressing in your note as well. When will the data centre capex actually let up? When will we start to see some softness in the year ahead?
Yeah, I mean, I don't know if you start to see softness, but I think you definitely see some sharp deceleration in terms of the data center capex spend. I mean, we're looking at about 35 to 40% growth here in calendar 2024 from kind of the big five spenders out there. We know who they are in terms of the hyperscalers, the big four plus Oracle, the names we kind of look at. And then as you kind of go into calendar 25. initially we're kind of, pegging more of a deceleration towards about 15 to 20% growth. Still very good growth. And then I think the question is all going to be, what are we looking at as we kind of go into 26 and 27, right? And right now our placeholder is about 5 to 10% capex growth as we kind of look in some of those out years into 26 and 27. But that said, we do see potential upside to those expectations, more of a bias to the upside than the downside. But that's how we're looking at it. It's not necessarily a let up in terms of capex spend. It's more, sharp deceleration from likely unsustainable growth trends that we're seeing. And you're seeing it right now in Nvidia's numbers, right? I mean, the last 2 quarters, they saw their data center business grow north of 400%. That's clearly not sustainable. We're looking at, closer to 140% growth here in the July quarter, and that will continue to decelerate also over the next couple of quarters.
So we're talking about the size of the pie. The pie will continue to get bigger, just not at the same rate. Can we talk about the slice of the pie? Is there any real upside to overall wallet share? And is there a threat coming from anywhere? How big is that moat around this company?
Yeah, so, I think that's an interesting question. So as far as Nvidia is concerned, I think a lot of, people out there kind of look at the competitive pressures out there as far as GPUs are concerned. And you got the likes of, the AMDs of the world, which, we love what they're doing. We like the recent acquisition they kind of made. They are kind of, definitely kind of filling up kind of what they need in terms to better compete with Nvidia on the GPU side of things in a growing market. So, that's great from a competitive standpoint. But as you kind of look more broadly for Nvidia on kind of, the data center wallet share, as they kind of roll out some of these new offerings with Blackwell, with a new kind of Spectrum X Ethernet offering out there. This new kind of Blackwell offering is really intended to be more of kind of this platform offering rather than kind of just a GPU offering. So what we mean by that is not only the GPU, but the CPU as well. Going to be more ARM-based in nature, we think, as you kind of see these next-gen data centers really take off. And that's important because we haven't seen ARM-based CPUs out there find any success in the market. When you kind of just look at Intel's recent guidance out there, they're clearly not seeing the orders on their end. We think you're going to see something different over the next couple of quarters from Nvidia, specifically kind of as they turn more into this platform-based offering. And that will kind of give them a next kind of leg up in terms of their revenue potential here, we think, over the next 12 to 18 months.
Pairing the ideas that you just talked about, hyperscalers, the biggest investors in Nvidia, how long until Nvidia is almost a competitor to their biggest customers?
It's interesting because to an extent they are. I mean, they've got a big investment out there in a company called CoreWeave, right? Where they're kind of, they've got a big stake in there and they're shipping a ton of GPUs out there as kind of this GPU or AI as a service type offering for that company. Nvidia definitely has the potential to kind of get more on the cloud-oriented side of things. Obviously, they sell their own kind of, full suite kind of systems out there. And, over time, I mean, I think there's definitely some concern probably out there from some of these cloud players out there, especially with what Nvidia has done on the software side of things, where you can essentially, if you're an enterprise customer, go directly with Nvidia and kind of buy those total systems outright. But that said, it's so capital intensive in nature, whereas it's really, we think, is going to continue to sit with these big cloud companies. And I don't necessarily think kind of Nvidia wants to kind of get to that next level where they're directly competing with some of these cloud companies, even though to some extent, you can kind of see that taking place.
Angelo, this was awesome. Got to do it again soon and follow up after the results later on. Angelo Zino there of CFRA. Lisa, we're both on the same page. The other thing we're really focused on as well, any sign of investor fatigue whatsoever in downstream use cases, because that's when the pressure starts to build on their biggest customers to start reducing investment decisions just a little bit.
We've been talking about this, and you put it really well, where it's sort of, is it a perk or is it a deficit that you have a cadre of 4 or 5 companies that are their main buyers? Because those are companies that if they make a bank and have plenty of cash, but on the other hand, they could decide to turn off the taps, and that would unilaterally be very difficult for Nvidia.
At the moment, at least, it's a real strength. We'll see if that sticks. Coming up next, Stephen Stanley of Santander, Collin Martin of Charles Schwab, on why Stephen Stanley thinks that maybe Chairman Powell made a little bit of a mistake on Friday. That conversation up next. Futures on the S&P 60 minutes out from the opening bell, a little bit softer across the board here on the S&P 500. Likewise on the Nasdaq, we're down by 0.1%, down by 0.5% on the Russell of small caps, which is where a lot of the leadership has been, Lisa, over the last week or so.
Yeah, and maybe this was single-handedly because of Emily Roland coming out and saying, really, guys.
Not a fan.
Well, yeah, she basically saying it doesn't make sense with the idea that the economy is softening and that the Fed is going to have to cut rates. Why should small caps outperform? You can be right on the macro call and wrong on market performance, and that maybe is what you're seeing today, although it's hard to draw too much conclusion from the action of this morning.
I know there are a ton of views out there. I'll just explain Emily's view just a little bit more. Her view is if the Fed is reducing interest rates, it's not for the right reasons, and ultimately that's why she doesn't like the rest of the equity market away from big tech.
She's saying buy quality, and that's the reason why she likes big tech, even though it's expensive, simply because they are delivering the earnings. I just have trouble understanding what valuations look like with lower rates after the rally that we've seen on the heels of higher rates, but also higher growth. It becomes this sort of challenging moment remember when big tech was actually a rates play?
Yeah, of course, yeah.
That got lost and it was sort of irrelevant. How does it become a rates story now, or does it just not, like she was talking about?
Previous regime, so not so long ago, low rates, low growth, buy growth,
right,
by tech. Higher rates, better growth, by the cyclicals, by financials.
Right.
I had a guest on earlier, he was basically saying lower rates better for the banks. We know why, given the experience of the last year, and kind of vice versa with the tech story of the last regime as well. Kind of flipping this all on its head, aren't we, a little bit in the last few days?
Or you could just make it really simple and say low rates, good for big tech, high rates, good for big tech, low rates again, good for big tech, and that's what we're going to see after the bell today.
It's been true. We'll see what we get from Nvidia. It's been a series of beat and raise, regardless of what you see from the Federal Reserve. That's Nvidia. That's the bond market too, with a 2-year at 386.50, yields lower by 3 basis points, the 10-year 382.92. Let's finish on foreign exchange. Lots of talk about these outflows in the FX market, engineered by lower interest rates of the Federal Reserve. Just this overweight consensus trade building up over the last couple of years of money that's just seeked out higher rates, and those higher rates have been the United States. And that's been a story of dollar supremacy, US supremacy, US exceptionalism. Are we undoing that with a few rate cuts at the Federal Reserve? Is that enough to trigger a lot of outflows out of dollar-denominated assets?
People were saying that, and then today, not so fast. Honestly, this is going to be the difficult question, especially the ECB officials. I want to go back to this. The ECB officials who we spoke to in Jackson Hole all had one concern: weaker growth. Poster child, Germany. How do you then talk about the potential for a couple rate cuts in the United States on the heels of not weakness that we've seen yet, just simply to normalize rates, is really undermining the idea of a stronger economy than what we're seeing over in the European region?
The euro negative 0.7%, euro dollar 111, just about. Under surveillance this morning, Vice President Kamala Harris and her running mate Tim Walz taking part in their first joint interview on CNN tomorrow night. It will be the first substantial interview for Harris since she replaced President Biden at the top of the Democratic ticket, if you consider sort of those other exchanges with reporters on the sidelines to be a broadcast interview, I guess. This truly is the first.
This is going to be very highly watched, perhaps as watched as some of the other events. It's sort of now a new calendar item before September 10th. Key question to me is Walz a liability or a benefit to her? Does it distract from her being able to answer questions? And if she doesn't answer with real policy, does that become a problem as well? Because those complaints will only get louder at a time where a lot of people want to even have a framework, a rubric to understand how she will govern.
It's become an issue. And people want to see a lot more of what we're going to see in the next 24 hours. And hopefully we do. Of course, this is a bias of the media. We want to see those exchanges. But also, don't you want to know what you're voting for just in terms of policy and not just vibes?
Who was it the other day who we were saying, isn't this becoming an issue? And they said, it's an issue for media people, but it's not an issue for the polls. People are still voting for it.
It's working in the polls. Let's put it that way. I mentioned that a little bit earlier. Traders on hold ahead of the market's so-called make or break moment after the closing bell when AI giant Nvidia reports earnings. Any disappointment is expected to rule markets given the company's weight in US indexes. Nvidia is up almost 160% year to date. After the numbers drop, our good friend and colleague Ed Ludlow sitting down with CEO Jensen Huang at 6:30 Eastern Time. I can tell you we'll catch up with Ed in about 20 minutes. So if you've got questions for Ed, shoot them over We'll talk to him in about 20 minutes' time. Traders also keeping an eye on this week's jobs data, jobless claims and core PCE, as the labour market becomes a sticking point ahead of the Fed's decision on September 18th. Stanley of Santander with this to say: I'm especially anxious to see the August employment report. While they will both be important, I would gauge the August jobs report as likely even more pivotal than the August core CPI reading. Things have changed a lot in the last 12 months. Stephen joins us for more. Stephen, good morning to you.
Good morning.
There's a line in your research: you don't love that Powell gave up optionality. Was that a mistake? What don't you love about it?
Yeah, I think, so my view is the Fed's going to go 25 in September. And I think that's where, it seems like that's where most of the officials were leading it up to Jackson Hole. You heard words like gradual and methodical, and there seemed to be a lot of tea leaves pointing in that direction. And the markets really were only discussing whether the Fed was going to go 25 or 50, not whether they were going to go at all. So he pretty much locked in a September move. Okay, fine. And I guess he's waiting and going to let the data dictate what the markets are going to price in, which can be dangerous if the markets go a different direction than what the Fed was intending.
Let's explore that danger. I assume you mean a big upside surprise in the jobs report, and unemployment drops back. We get like 300K on payrolls, unemployment drops back. Are you saying that's why it's dangerous?
Well, that would actually be, I think that would be fortuitous in the sense that the markets would then probably scale back their expectations naturally. I guess if it goes the other way and the numbers are somewhat weak again, not disastrously weak, but a little soft again, the Fed is still thinking they really only want to go 25. Look, it's the first move. We want to be cautious, but the markets are way out ahead of them.
You think there's a conversation that begins about 75?
I don't know about that, but I mean, certainly the odds of a 50 would go up if the labor report is on the weak side.
What's the argument to not move aggressively, based on this argument that inflation has calmed down materially and that monetary policy is significantly tighter, more restrictive than it was 6 months ago or a year ago, simply by virtue of that discrepancy?
Yeah, I think two sets of points. One would be on the economic fundamentals. I mean, the economy still seems, by and large, pretty healthy. I mean, GDP growth was, 2.5% to 3% in Q2, and it looks like it might be similar to that in Q3. Consumer spending has been strong. So we have seen a little bit of softening in the labor market, but it doesn't feel like the economy's just tumbling off a cliff. At the same time, inflation, while it has come down, is not quite back to target yet. So there's arguments there, I think, for going cautiously. More importantly for me, though, is looking historically at the way the Fed has tended to operate. And they do tend to be more cautious at the beginning of a cycle. And the reason is because they like to go in a series of moves, right? They don't want to go back and forth. They don't want to ease and then have to come back and tighten again. So they kind of tiptoe into it a little bit. And they've done that historically, both in hiking and in easing cycles.
Is your biggest issue with market pricing right now the magnitude of rate cuts or just the pace of how quickly the Fed gets there?
I think it's the latter. I actually have been pretty aggressive on how much the Fed would do, say, by the end of next year. And the markets have kind of come in line with that at this point. I just don't see them moving in 50 basis point chunks over the next few meetings.
Did you not read anything into Fed Chair Jay Powell not using those words that you mentioned, the gradual, methodical, all of those types of language indications that we heard from other Fed officials?
Yeah, I think that was very significant. And I was surprised. I thought he would try to kind of push the market off of that 50 basis point move. I guess my takeaway after having a couple days to think about it is I feel like maybe his audience was not so much financial markets as it was the general public, right? I mean, I think he felt like he was obligated to give the broader audience, whether it's the political realm, the media, kind of Chairman Powell speaks a lot to the broader public, right? And I think he just wanted to say, hey, heads up, we're going to be easing soon. Because, I mean, for the markets, that was no news. The markets have been, as I said, but just debating what the size of that move was going to be.
There was a word in that speech that jumps out, though, and it was my confidence. There was a separation there between his belief, I think, and the committee. And we had a guest earlier this week making that comment as well. And I was trying to think whether this was the Federal Reserve chairman trying to push the committee into a bigger decision that maybe some were reluctant to make. And you can see that in the minutes from the July meeting, that there were some people pushing for a rate cut and a lot of people weren't ready to move. And I think you could sense that in anticipation of the speech in Jackson Hole. In the 24 hours before that, we had a series of policymakers Governor Bowman as well, sounding somewhat reluctant to reduce interest rates in September, and certainly reluctant to go as far as he went in that speech. Yeah. And I always wondered whether this was sort of like Draghi-esque, pushing the governing council to make a decision they weren't quite ready to make. How much daylight is there between him and the rest of the committee?
Yeah, we'll never really know for sure. Powell is someone that has tended to try to operate by consensus, so he has not been as much as, say, a Greenspan or even a Bernanke, someone that's tried to pull the committee hard in a certain direction. But that may be going on behind the scenes. There's no doubt that when you get close to a turning point, that's when the nuances, the shades of gray come out. And as you say, we have seen that. We've seen some people who are clearly more eager to get going than others. Perfectly natural to see that at this point in the cycle.
Does it matter how fast they go?
I don't think it matters in terms of one single move, what it might mean for the economy. Does it matter whether they go 25 or 50 in September? Does it matter whether they go in September or October or November? I mean, it's not going to make or break the economy, but I think it does make a difference in the sense that it will manage market expectations, and financial market conditions do matter. Powell and others at the Fed have told us that, and so. If let's say, hypothetically, let's say the Fed goes 50 in September, I would have to imagine the markets are going to price in 50s again and again and again. And so,
and maybe more.
Do you want to kind of feed that beast?
Before you go,
that's got to be a.
What's your number for next week, for next Friday?
So I'm actually a bit optimistic. I do think the number is going to be better. I think July was a little bit distorted. So I've got 190 for payrolls, and I've got the rate ticking back down to 4.2.
The median right now is about 155. Small survey, though, still putting together those estimates. Stephen, thank you, sir. Thank you very much. Stephen Stanley there of Santander. If you are joining us just now, we're 50 minutes away from the opening bell, so welcome to the programme. Let's start with the equity market price action. A little bit negative here by 0.06% on the S&P 500. The Nasdaq 100 down by about 0.05. Some underperformance on the Russell, on the small caps down by 0.4. Looking for something close to 200k on payrolls next week from Santander and Stephen Stanley after we heard from Andrew Honhorst of Citi a little bit earlier this morning, looking for about 125 in their estimate.
Yeah, and why it matters is the sort of delta between 25 and 50 and the pace of getting to lower rates. You mentioned that a couple of Fed officials on the committee talked about the potential for a July rate cut. We have some color from our colleague Christopher Condon out of the Fed team on Bloomberg News on who those members were, which I thought was interesting. That it was New York Fed President John Williams and Austin Goolsbee of Chicago. And I wonder if the regions are sort of important in terms of metropolitan areas in the Northeast, or how we can sort of extrapolate this out. But nonetheless, kind of just some interesting color, especially with one of the big three, John Williams, looking for a cut as recently as last month.
A cut on the so-called discount rate. And I think for a lot of people reading between the lines and suggesting maybe there was a push out to cut federal funds too. Latest detail there. The other thing I want to talk about as well is the bond market. So let's turn to fixed income, 2-year, 10-year, 30-year, and the shape of the curve. The 2-year versus the 10-year right now, let's call it effectively flat. Let's just call it that for the sake of the conversation. 386.50, 382.92. Why would I want to take on additional duration for basically the same yield that I can get at the front end of the curve? Now, we'll get a lot of bond salesmen come on the programme and say reinvestment risk, reinvestment risk. Other people would just suggest to really unlock that cash at the front end of the curve, you need a high yield at the long end. And what we heard from BlackRock 43 minutes ago was exactly that. You need this curve to normalise. So BlackRock, and him specifically, looking for this curve to normalise and looking for something like 0 to 60 basis points of steepening. So you get 60 basis points of steepening. He thinks you really start to unlock some of that cash and people start to deploy it further out along the curve.
To me, the big test is going to be tomorrow. We've got $44 billion of 7-year auction notes being auctioned off. And to me, that will be an indication. Do you see the same type of success that we saw yesterday in the 2-year note and today potentially with the 5-year note in the longer duration because of that concern, the lack of certainty? Even if you don't believe ultimately it will face off with a market pushback, there is a real question about how much this has already been discounted, the idea of the fiscal overhang in the United States.
Collin Martin and Charles Schwab with us around the table. Collin, extending duration, has it become less attractive, given what we were just talking about moments ago?
It has become less attractive. We've been talking about this for a while. I wanted you to be the first one to hear it because we've been talking about it for, I think, close to 2 years now. And all the points you made are the key reason. It's just the risk reward between investing in, say, a 10-year at 3.8 and the idea of rolling T-bills, because you're basically making a decision if you're making that sort of investment. It's just less attractive now. We also think the 10-year can kind of hover in this range for a little bit, and we agree with the points you made about yield curve steepening. We think it should steepen for good reasons and really a bull steepener as short-term rates fall between long-term rates. If we look historically what happens in a normal, still positive trend growth environment, the yield curve should be steep. So I think we'd see short-term yields fall below that 10-year, and we think it could hover around here for a while. So that risk-reward balance from a tactical standpoint isn't as attractive. We still think investors can consider it. We're kind of saying at benchmark duration, but we're not really pounding the table as much as we were when the 10-year was at 4.25%, 4.5%, or 5%.
I could hear Bob Michael in my ear saying, do people who missed out on buying the 10-year yield at 5% yields on October 19th, 2023 really care about the yield curve dimensions here? Are they really trying to do calculus here to understand how much that curve is going to shift at 3.83%? On an absolute level, why wouldn't you say, all things being equal, yields will come down so you can have conviction that with any slowdown enough for the Fed to be cutting rates, you can invest in longer-term bonds and be just fine?
Well, I think just fine is a good way to put it. If we look at what that yield is, if you hold for that term of the bond, you get certainty there. But there is potential opportunity down the road once those rate cuts come. And going back on John's points before, that risk reward doesn't look attractive. How do you get regular investors to understand what a yield curve steepening means? And I think that matters because at the end of the day, for a lot of investors, it's yield, it's income. And I can still earn higher income with short-term rates, short-term investments. As the Fed does begin to cut rates and once that yield curve normalizes, we think maybe then there'll be more of an opportunity. Once the Fed gets to, there's no magic number, but if it gets to that 3% area and we do see a 10-year still in the 3.5% to 4% area, that'll probably be more attractive for a lot of individual investors.
You're focusing on just the income aspect and how to get the most income at a pretty safe moment. And I'm wondering, you're talking a lot about investment-grade bonds. Spreads have come in pretty significantly. Why is this still the correct way to add income rather than duration, rather than some other ways to play it?
I think if you look at duration, there is risk to the downside should our outlook, turn incorrect. And we see yields rise. That's a big, sensitivity to that increase in interest rates. If we look at investment-grade corporate bonds from a credit risk standpoint, we're just really not that concerned. We are worried that growth can slow, but we're not worried that a recession is necessarily on the horizon. That's kind of our firm view at Schwab. We're seeing signs here and there, but not in the next, quarter or two. If you look at the investment-grade market, fundamentals are still relatively strong. We're seeing the share of BBB bonds come down, which is a positive development. And we think those companies have investment-grade ratings for a reason. Strong cash flows, a lot of cash on the balance sheet. So we think you're in good shape. But again, those yields have come down also. We talk about risk reward. Spreads are low, whether it's investment grade or high yield. And if you look at that IG market, we could have gotten 5.5% yields about a year ago. Now we're looking more like 4.5%. And to get closer to 5, you have to take more credit risk in BBBs. And not that we'd shy too much away from that, but we wouldn't say dive in headfirst in BBBs in case growth does slow more than we're expecting.
Before you go, can I just nail you down on something? So top of the interview, we were talking about extended duration has become less attractive. If there are limits to price appreciation, given how we've reset things, are you questioning the efficacy of treasuries as a ballast in the portfolio as well, or is that a step too far?
That's a step too far.
Okay.
We still think bonds
it's the second time
always
I've done that
make
today.
Sense.
All right. Collin, thank you, sir. Collin Martin at Charles Schwab. You can see what I'm trying to get at this morning.
I appreciate it. I think it's a good way to kind of create some drama on a pretty drama-free morning. But I actually am with you. It's sort of, there was a moment where bonds were not the ballast of the portfolio. People went into gold. People went into Bitcoin.
Still going into gold.
They're still going into gold. They're still going into Bitcoin. But I just wonder if that dynamic has shifted back to what it has been traditionally.
I've asked that question twice, I think, in the last hour. Both BlackRock and Schwab are saying that's not the case. Collin, it's good to see you. Thank you, sir. Thank you very much. Equity futures right now on the S&P, just a little bit softer going into the opening bell, about 42 minutes away. Let's give an update on stories elsewhere with your Bloomberg Brief. Here's your Hara Hackers.
Hi, John. We're seeing some retail stocks moving into the open. First up, Kohl's. Those shares are higher 2% in the pre-market after the company boosted its full-year profit outlook as it makes progress in cutting expenses and reducing inventory levels. However, the retailer did report a revenue miss for the second quarter, citing a, quote, challenging consumer environment. Meanwhile, Foot Locker shares are falling in the pre-market, down more than 8% after the retailer reported earnings that failed to satisfy investors. Foot Locker beat on revenue and snapped 5 consecutive quarters of negative comparable sales, showing a 2.6% gain in the second quarter. But that update was not enough to sustain the stock's 46% rally since its previous earnings report in May. And Britain's Dan Evans won the longest match at the U.S. Open since tiebreakers were introduced in 1970. Evans' upset win over 23rd seed Karen Khachanov, taking 5 hours and 35 minutes. Evans also fighting back from 4-love down in the 5th set to win the marathon match. Elsewhere, 3rd seed Carlos Alcaraz comfortably moved into the second round, as did women's top seed Iga Swiatek. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. Thanks for this morning. Up next on the programme, we'll set you up for the day ahead, including earnings from Nvidia after the closing bell. We'll catch up with Ed Ludlow, who has a sit-down conversation with the man at the top of that company a little bit later this afternoon. Ed, just around the corner. "38 minutes away from the opening bell. Equity futures softer here by 0.1%. The bond market quiet, unchanged on a 10-year, 382.16. The trading diary, the calendar for the next 24 hours, nothing quiet about it. Nvidia just around the corner. We'll get Fed speak from Raphael Bostic at 6 p.m. Eastern tomorrow. Another round of jobless claims and the second reading of US GDP on Friday, core PCE and UMich sentiment. Well, let's turn to today's main event. Nvidia reporting after the closing bell. Bloomberg's Ed Ludlow sitting down with the CEO, Jensen Huang, in an exclusive conversation at 6:30 Eastern Time. I'm pleased that Ed's dropped by early this morning on the West Coast to catch up with us. Ed, fantastic work, buddy, and I'm looking forward to the conversation a little bit later. What's the lead question for you and the team?
Yeah, I think there really is only one question right now, John, which is when does what's happening move beyond hyperscalers? Like the story around Nvidia is very basic, that they make a high-performance GPU or an AI accelerator, and all the investment and the capital expenditure that we've discussed is concentrated in just 5 names, which is the biggest cloud providers plus Meta. And for all the big picture forecasts and the debate about how enduring this investment cycle is, there comes a point where you just have to ask, well, when is there going to be more than that? The small and medium-sized enterprises, governments, because it's hard to see the long-term demand, although right now in the short term, there's no sign that the demand is fading, is there?
No, which is a reason why it seems like people are prepared for potentially a $300 billion surge in the share prices after market.
Correct.
I'm just wondering if we have any sense from him about what the next phase is. We were just speaking with an analyst, Angelo Zino, who is talking about the potential to move out into systems, which is what we're going to hear maybe about the Blackwell program. How much is this sort of them getting bigger and then eating their own customers?
The idiosyncratic story is exactly as you described, that Nvidia wants to do more, occupy a broader space, which includes services and software. You know, when you think about the basics, again, we're talking about GPUs that go into a rack, that go into a server, that go into a data center. They just want to provide more of those complete systems. But actually, you know, Jensen Huang, people call him the godfather of AI for obvious reasons. He has a firm grasp on the end use cases of what AI development is unlocking, be that robotics or acceleration of healthcare or drug development, things like that. He likes to talk about that. But what I don't have a clear understanding of is for every dollar spent or given to Nvidia, does he have a firm understanding of how many dollars are coming out for the customers in terms of top line growth or whatever it is for them? And I think that would be quite interesting to discuss as well.
Hey, Ed, looking forward to the conversation. Join us tomorrow morning following that one.
I will.
It's going to be fantastic. Thank you, sir. Ed Ludlow sitting down with Jensen Huang, the CEO of Nvidia, 6:30 Eastern Time later on this afternoon. Following those numbers, big earnings release from Wall Street coming up after the close, later a little bit later.
The liability of getting too big. I'm just wondering at what point we're talking about they want a bigger share of the pie at a time where they already are the biggest company in the U.S. and possibly the world soon to be. So to me, it just sort of, some of the regulatory pressures might get interesting too.
It's interesting, the line of questioning that Ed's sort of got prepared. It's the conversation we've had all morning. It's less of a conversation about them and more of a conversation about their biggest customers right now.
How long can they keep investing to the degree that they have been without getting some pushback unless they get some real return on investment?
Look out for Ed leading our coverage of all of this on the West Coast throughout today. Coming up tomorrow, Dan Ives of Wedbush When they say people, calling me godfather of
One
AI.
person.
Dan Ive of Wedbush, Brian Levitt of Invesco, Anastasia Amoroso of iCapital, Earl Davis of BMO. Good luck for the rest of the trading day from New York City. This was Bloomberg Surveillance.